Before we start this video, do like and subscribe to our channel and not miss on any updates.
So let me share the screen, my dear friends, to discuss another interesting case study, that is case study number 3, my dear friends. What is that, my dear friends? Case study number 3. An interesting case study. Let's start looking at that. Come on, guys. FST Limited. I love this case study because this case study is completely taxation. Crazy case study. He is engaged in the business of manufacturing and export of ready-made garment. They are in manufacturing and export of what? Ready-made garments like t-shirts, skirts, top and similar casual wear. CAT is the statutory of the company and also provides tax consultancy services. Very good. He also handles matters pertaining to direct and indirect taxes of the company. On a Monday evening, he had gone to the company's office located in Noida for participating in a pre-arranged meeting with certain key directors of the company on some matters. The said location also houses company's manufacturing facilities. So that place is manufacturing facilities also, and there he went for the purpose of participating in a key meeting with certain directors. Barely had the meeting started, a team of 3 officers from the income tax department descended upon company's premises to conduct TDS survey. So as soon as the meeting started, my dear friends, some officers have come for the purpose of conducting TDS survey. And after completing necessary formalities, they asked for a financial statement for last 3 years and the evidence of TDS returns filed during those period. You're getting my point, everybody? Next. Thereafter, they took control of systems of the company containing books of accounts. Meanwhile, directors requested CA to stay there and help them out in the situation. So if you observe the whole scenario, what is happening is there is one company which is engaged in manufacturing and export of garments, ready-made garments. And that company, one chartered accountant went for a meeting with the directors. And when the meeting just started, income tax department officers have come for the purpose of conducting the TDS survey. Next slide. After perusing, what is that line, my dear friends? After perusing company's accounts books, documentary evidences, including bills for few hours, team has summarized the following points or purported lapses by the company in the matter of TDS deduction and the incidental issues. Now, what is that they have found out? Let us see. It was pointed out by the company that the company has made payments during these years to Bharat Container Corporation Limited, a government-owned PSU. To government-owned PSU, they made payments. Company operates container cargo services and its terminal is linked with rail lines to various gateway ports, including one at JNPT, Navashavi, Mumbai. FST Limited sends its export-bound cargo utilizing above PSU services. On going through the bills raised by BCCL on FST, it was observed that these pertain to charges levied by BCCL for handling containers, road transportation charges, and railway freight. The team has pointed out that tax has been short deducted for above payments made to BCCL. So this company has made payment to Bharat Container Corporation Limited. For what purpose? For handling the containers, road transportation charges, and also rail freight. And the team, that is the income tax department team, they have observed that TDS is short deducted for payments made to the Bharat Container Corporation Limited. Next slide. FST Limited has made payments during these years to certain companies providing clearing and forwarding agent services, C&F services, to carriage of goods. The team has pointed out that tax has been deducted on this payment at inappropriate rate, leading to short deduction of tax. And the team insists that these payments are in nature of brokerage and warrants tax deduction at 5%. Crazy point. So generally, 5% commission TDS will come into picture only when a person is engaged in sale of goods or purchase of goods on behalf of another person. And for sale of goods on behalf of another person, he gets something called commission. But if a person is just providing service of what you call just carrying the goods and all, it's something like a transporter. It's something like what you call transportation service. Next point. FST Limited has also recently participated in a fair in Mumbai in 23-24 and has paid charges of 5 lakh rupees towards makeshift stall and use of furniture in an exhibition center owned by the company. The team has pointed out non-deduction of tax at source by FST Limited on the same. What has actually happened? They have participated in a fair, that means exhibition in Mumbai, and they have paid 5 lakh rupees towards makeshift stall and use of furniture. And on that, they have not done TDS. During survey, team also stumbled upon service bills of few clearing and forwarding agent. These agents were acting as shipping agents of non-resident ship owners. The moment you talk about shipping agent of non-resident ship owner, non-resident shipping business in income tax is covered by section 172, where whatever charges they collect, whatever freight income they get, on that directly they offer a presumptive income of 7.5%. This concept is given by section 172. FST Limited has paid ocean freight to these shipping agents of non-resident shipping lines. The team had pointed out that tax has not been deducted on ocean freight paid to these shipping agents. Before leaving, the team raised show cause notices relating to above issues. Just when he was working on preparing a reply to show cause notice, after a few days in his office, CA received a copy of notice forwarded by the company. And the said notice was issued by Department Anti-Evasion, CGST Division. Income tax TDS issue is not over. GST issue has come. That the exporter company has been flagged as a risky exporter on the basis of risk analysis by DGARM, that is Director General of Analytics and Risk Management. Director General of what? Analytics and Risk Management. The said notice contained a long list of documents to be submitted by the company, including copies of GST return, reconciliation with ITC, reflecting on the portal, reconciliation of bills, financial statements of last year. All these documents they asked. The company is exporting goods on payment of IGST. Its export-bound shipment attracts GST at the rate of 5%. Subsequently, a departmental team also visited premises of the company, and on going through the documents submitted by the company and after conducting necessary verification, the team raised following issues. So many issues, man. What issue they raised? The team pointed out that fabric, which is the main raw material for manufacturing of garments, having a taxable value of 50 lakh, attracting GST at 5%, was destroyed in a fire. Oh my God. So let me tell you, block credit, section 17.5, which clearly says in case of goods lost or stolen or destroyed or disposed of or written off by way of gift or free samples. In that case, my dear friends, whatever ITC you claim, that ITC needs to be reversed because the goods are lost or destroyed. Next. Company has been availing services of security agency for providing it with manpower. Company has paid an amount of 10 lakh rupees to one such security agency proprietorship concern up to the date of team visit. It insisted that company was required to pay GST under reverse charge mechanism. Very true, actually. If you take security service from other than company, then receiver has to pay GST under RCM. No doubt about it. It has been pointed out that the company has received duty credit scripts. They are something like in case of service export from India scheme, merchandise export from India scheme and all, there is something called duty credit scripts what we get based on exports what we have done on the foreign trade policy of the government. These duty credit script in turn have been sold by the company to third party, and supply of such credit script is exempt from GST. Very good. And the team point out that company is required to reverse ITC on the common inputs. Wow. But let me tell you, in case of inputs, common inputs related to exempt and taxable, we have something called Rule 42 and Rule 43. Rule 42 in case of inputs and input services, Rule 43 in case of capital goods, which clearly says that whatever credit you have proportionate to exempt turnover divided by taxable turnover, that credit needs to be reversed or paid to the government. But in that exempt turnover calculation, my dear friends, we reduce something. That is, exempt turnover does not include number one, service by way of extending loans or advances where the consideration is interest or discount. Number two, my dear friends, duty credit scripts. They are not included for the purpose of exempt turnover. When they are not included for the purpose of exempt turnover, the credit need not be reversed. Very, very interesting point. See what is the question they have asked. First question. Considering the matter stated in 1 relation to tax short deduction of tax from payments made to BCCL by survey team. Come on, friends. What is the payments they made? If you observe carefully, my dear friends, come on. What is the payments they made to BCCL? They made payments towards what, my dear friends? Handling containers, road transportation charges, and railway freight. So let me tell you, in this context, my dear friends, whatever handling charges they are provided, that is a pure service. And on that, my dear friends, TDS is definitely supposed to be done. But my dear friends, let me tell you that railway freight on that TDS will not apply, because section 194C clearly specifies that work where TDS is on work, that is, work will include carriage of goods or passenger by any mode of transport other than railways. Other than what, my dear friends? Railways. So let me tell you the point very clearly. That is, TDS under section 194C will apply on handling charges, but not on railway freight. While work is defined under section 194C, which clearly says work includes carriage of goods or passengers by any mode other than railways. So if it is railways, my dear friends, that is not covered here. If it is railways, that is specifically not covered in 194C. And when it is not covered in 194C, there is no question of TDS on the railway charges. Are we getting the point, everybody, my dear friends? All of us, please reply. Come on. Very, very important discussion. Kindly, please reply. Good. Thank you very much. Let me get back to the case study. Good. That should be the participation. So first MCQ answer is very clear. Come on, what is the answer? First MCQ. Read the point and tell the answer. Come on, friends. First MCQ, what will be the answer? First bit says what? TDS is required on handling and railway freight. That's not okay. Second, road transport and railway freight. That's also not okay. C point, handling, road transport, and railway freight. That's also not okay. But TDS is required to be done on handling charges and road transportation charges, but it's not required deducted on railway freight. So very clearly, answer is option D, my dear friends. This is the correct answer, because on railway freight, TDS is not required. Second which, survey team has raised issue of application of inappropriate rate while deducting tax from payments made to certain companies providing clearing and forwarding services at JNPT Navashava, Mumbai. Which of the following statement is correct? So let me tell you, they are actually providing what? They are providing service of clearing and forwarding. They are providing service of what? Clearing and forwarding services. And the team which has come, they told it is something like commission, do 5% TDS. But how it is a commission? Commission will come only and only in case of buying and selling of goods. Correct, no, my dear friends? If there is a buying and selling of goods, then only we call it as commission. It is clearly a payment made to clearing and forwarding agent for the purpose of carriage of goods. So there should not be a question of TDS under section 194H. But in this case, at least TDS under section 194C can come. TDS under section 194H at 5% will not apply, since it is not commission. Commission is only in case of purchase or sale of goods. However, my dear friends, in case of payment towards carriage of goods, TDS under section 194C, that will apply. For sure, TDS under section 194C will apply, my dear friends. In that, there is no doubt. Good. So what is the answer? First bit 5% is not okay. Second bit 5% is not okay. Third bit 2% and not 5%. And what is D option? TDS at 5%. Tell me guys, what is the answer? Come on, please tell. Please tell what is the answer, my dear friends. Come on. Obviously, the answer is option C, my dear friends, because TDS is supposed to be done at the rate of 2% under section 194C. Very, very, very interesting point. Clear? Good. Third question, my dear friends. It was pointed out that FST Limited have failed to deduct tax at source on payment made to a company owning exhibition center in Mumbai for make a shift stall and use of what, my dear friends? Furniture. Which of the following statement is correct? So let me tell you, we have got something called section 194I TDS, my dear friends. 194I TDS, which clearly says in case of land and building, it is 10%, land, building, furniture, it is 10%, plant and machinery, it is 2%. Plant and machinery, it is 2%. So let me write the point. As per section 194I, TDS will apply on payment of rent. And the rate is 10% in case of land, building, or furniture. And it is 2% in case of plant and machinery. Now tell me, in this particular question, what is covered there? We are talking about something called make a shift stall and use of furniture. So very clearly, my dear friends, the TDS rate will be 10%. And the answer will be option B, my dear friends. Because very clearly, TDS is supposed to be done at the rate of 10%. And in fact, my dear friends, 194I, let me tell you, the limit under 194I is only 2,40,000 per annum. Clear? Good. Next, fourth bit. As regards destruction of stock of raw material in fire, which statement is correct? They have to reverse ITC, they have to reduce output, they have to increase output. Issue raised by the team is not correct. I want to listen from you. Your answer. What is your answer? Tell me, my dear friends. Come on. You know the answer already very clearly. Perfect. Almost everybody gave the answer. No doubt about it. Answer is option A, my dear friends. Answer is option A, my dear friends. They have to reverse the input. By the way, it is because of what? Section 17(5), which is a block credit. In case of block credit, goods lost, stolen, destroyed, written off, or disposed of, then credit has to be reversed. There is no doubt about it, my dear friend. I believe that we are getting clarity on this point, everyone. Next. Good, very good. Next point. Fifth question. The team has raised the issue of non-payment of GST on, say, availing services of security agency under RCM. Which of the following statement is correct? GST of 0.5 lakh and ITC is required to be taken. GST of 1.8 lakh is required to pay and reverse charge, and 1.8 lakh they'll take it as ITC. Okay. Then 0.5 lakh, 1.8 lakhs, but no credit. So let me tell you without any second thought, answer is option B, my dear friends. Because in case of security service, let me write very clearly here. In case of security services, straight figure what they told in the law is that RCM will apply if supplier is any person other than body corporate and recipient is a registered person. If supplier is any person other than body corporate, receiver is registered person, then only RCM will apply. And we'll pay GST at the rate of 18%. And let me also tell you, such GST paid can be claimed as input tax credit. Because this 18% first we'll pay using electronic cash ledger. And that GST, what we paid, we will again claim it as input tax credit. There is no doubt about it, my dear friends. I believe that we are getting clarity on this point, everybody. Good. Thank you very much. Love the participation. Come on. There is some descriptive question. Let us see that also. Descriptive question number 1. The survey team has raised the matter regarding non-deduction of tax at source on ocean freight paid to shipping agents of non-resident foreign shipping companies. How can CAT defend the company while preparing reply to show cause notice? As far as issue is concerned, quote relevant provisions of the law, including notifications and circulars on this subject matter. Wow, such a crazy question actually. So let me tell you very clearly, my dear friends, non-resident shipping business, this is taxable as per section 172. And there is a special procedure for payment of tax where before ship the leaves India, they are required to pay tax and then leave, my dear friends. And law told the presumptive income will be 7.5% of the freight what they charge. 7.5% of the freight what they charge, that will become the presumptive income, my dear friends. CBDT has clearly clarified that section 172 deals with shipping business of non-resident, my dear friends. There is no doubt about it. I hope you are getting clarity on this point, my dear friends. So they are required to pay the tax, and tax rate is not 7.5%. 7.5% is what, my dear friends? 7.5% is basically what? The presumptive income. Are we getting clarity, everybody? And they should file the return within 30 days from the date of departure of the ship, my dear friends. They should file the return within 30 days from date of departure of the ship. This is a very, very clear-cut provision what they gave in the law, my dear friends. All of us getting clarity, my dear friends? Good. Now, let me tell you, my dear friends, section 172 overrides other provisions of income tax. Other words, my dear friends, let me tell you, TDS provisions under section 194C or section 195 will not apply. 194C is payment to contractors and 195 is payment to non-residents. That provisions will not apply, my dear friends. And 194C is only when payment is made to a resident. And 195 will come into picture only when payment is made to non-residents. Clear, my dear friends? Everyone said, and the point is very clear that since special provisions of section 172 are applicable, there is no requirement of TDS to be done, because section 172 overrides all other provisions, my dear friends. I hope we are getting clarity on this point, everybody. All of us, come on, please reply. Is this question clear for all of you, my dear friends? An interesting provision which actually makes a lot of sense. Good. Let me talk about the last interesting part of this question. What is that they have asked? The GST team has pointed out that companies required to reverse ITC on common input service relating to exempt supply of duty credit scrip. What is your opinion on this issue considering relevant provision of income provision of GST law? Let me clarify that to you. That is, my dear friends, as per section 17, if any inputs or input services or capital goods are used for the purpose of both exempt and taxable supplies, then, my dear friends, ITC related to exempt supplies is not allowed. And in this context, my dear friends, there is rule 42 in case of inputs, and input services. And let me also tell you, we have got something called rule 43 in case of capital goods, which clearly says that ITC related to exempt supplies is to be reversed. And in this context, it is important to note one interesting point, my dear friends, that is exempt supply does not include. Come on, my dear friends, what is that line I am writing? exempt supply does not include something interesting. Come on, what is that line I wrote? Exempt supply does not include, my dear friends, service by way of extending loans or advances where the consideration is interest or discount. When I say it is not included in exempt supply, what does that mean? The credit related to this need not be reversed. Second point, value of duty credit scrips. So that means ITC related to above two cases need not be reversed. Now, in this context, let me ask you one question, my dear friends. I'm expecting an answer from you. Please think properly and reply and tell the answer. That is, if output is zero rated, can I claim input tax credits? Come on, my dear friends, please tell me, if output is zero rated, can I claim input tax credit? Am I supposed to reverse the credit? No. 100% credit is allowed. Because the logic is very simple. This credit reversal concept is only in case of exempt supply, but not in case of zero rated supply. And zero rated supply covers only two things. Number one, exports. Number two, supplies to SEZ. Apart from these two, nothing else is covered in zero rated supplies. Very, very interesting point. And you have to understand that since this duty credit script is excluded from exempt supply, whatever is credit is related to that credit need not be reversed. So that is the story of this very, very interesting case study number 3, my dear friends. I'm pretty sure we got a very good clarity of thought on this case study number 2 and case study number 3, my dear friends. Kindly please reply once. Good. That's all, my dear friends. For today's session, that's it. In the next session, we'll talk more in detail. And the next session, we'll cover 3-4 interesting case studies. But for today's session, that's it. Thank you so very much. Take care. See you all very soon. Shivateja signing off. Bye-bye. Thank you so very much, my dear friends. And I'm sure we got very good clarity. Kindly please reply once and then take a leave.
So now we're heading on to case study number 4. Okay, which is on page number 26 in this PDF. 1 second. So now we'll be doing case study number 4. Again, this has got only one multiple choice question which we have to cover for company law. Let's see. Okay, now we are going to read the question and let's see if we need to read the case study, we will read the case study. Otherwise, you can simply directly just answer the question. Okay. Question number 5, case study number 4. Under the provisions of the Companies Act, the books of accounts and records are required to be kept at the registered office of the company. However, the manufacturing facility of the company is located in Noida in the state of Uttar Pradesh. In the light of the above, which of the following statement is in accordance with law? Okay, so here directly they have mentioned what to refer. In the Companies Act, books of accounts are to be kept at the registered office. Now see, because here we are mentioning books of accounts, you should know the section of books of accounts. Otherwise, you can refer to the list of sections. There you will find the section number 128 specifically is about books of accounts. Now, in this section number 128, it mentions that the books of accounts have to be kept at the registered office of the company. Okay. However, if the board of directors, they want, they can move the books of accounts to any other place also. Okay, now this section, along with the relevant rules, it mentions that if the board of directors want, they can move the books of accounts to any other location also, but they will have to inform the registrar of companies. That's it. There is no resolution required. See, these are books of accounts. Even if you don't know the section, books of accounts are general books, like their vouchers, their papers, their documents. So in order to move them from the registered office to any other location, it's not a very big deal. It's a company matter. It's an internal policy matter. Okay, so it does not require you to take a resolution or something in the general meeting. Okay, so section 128 also says that it simply requires you to inform the registrar of companies. It mentions that we have to intimate the registrar of companies within 7 days and we have to file the form AOC 5. Okay, that's it. This, if you're doing this, then sufficiently we can move the books of accounts to another location instead of registered office, right? Based on that, we have to select the correct answer. So say here you don't need to refer to the case study also. You can simply look at the options and select the correct option. Okay. So first option reads, the company can keep books of accounts in Noida by filing form AOC 2 in 30 days. Second option, can keep books of accounts in Noida by filing AOC 4. Third option says AOC 5 within 7 days. And fourth option is no recourse is available. Which is the correct answer? Tell me. Tell me, tell me, tell me. We discussed option C is the correct answer. Okay, AOC 5 has to be 5. All right. Okay. Okay, we'll move on to the next and the final case study for today.
Let me discuss the next case study, my dear friends. Next case study is one such case study which has got completely related to tax. So much of content is there in that case study related to tax, my dear friends. Yeah. So case study is visible. Yes, thank you so much. Let me proceed. Let's go a little carefully, my dear friends. A very, very interesting case study. Please be very careful. Please concentrate, everybody. Kindly please confirm. Can I proceed? Yeah, thank you so much. Come on, let's look at that case study. Home Fab Private Limited, incorporated in May 2023, having registered office in New Delhi, started construction of its premises building in Noida by using prefabricated structure, common and prevalent in these times. Nowadays, a lot of people are using that prefabricated structure and all, so that construction becomes more quicker and faster. And prevalent in these times, and building comprising about 1 lakh square feet of covered area was ready to use by the end of July 2023 at a cost of 6.5 crores. So at a cost of 6.5 crores, they got the building ready, which is a prefabricated structure. Company also obtained GST registration in the month of May 2023 in the state of Uttar Pradesh. Very good. The company had already ordered in advance import of certain new textile machinery from South Korea at a cost of 8.65 crore. Oh my God. Further, indigenously, previously used machinery at a cost of 2 crore was also planned for installation. So they want to use some old planter machinery also. Company was able to bring imported as well as indigenous machinery to its premises in Noida only in the first week of August 2023 and was able to kickstart its commercial production of textile made-ups from 1st September 2023 only. And the company has had huge profits during previous year 23-24. And let me tell you, my dear friends, whenever there is a company like this, which is engaged in manufacturing, government has brought wonderful initiatives. Especially they told, we'll charge income tax rate to you only at the rate of 15% by applying a beautiful section called 115BAB. A brilliant section actually. Come on, we'll see that. Next point. The made-ups. Come on, my dear friends. Paragraph B. Please see that. The made-ups of the company got a very good response in the overseas market of USA under the brand of Home Fab. And company had captured good chunk of export order via digital and online marketing platform, beating its Chinese rivals. So wonderful. So they're beating Chinese rivals and they got the order, my dear friends. So getting clarity, everybody? Next. The made-ups of the company, company has chosen to export on payment of IGST. Just some time back on the previous question, I discussed what will happen in case of we go for option of export with payment of tax, export without payment of tax. Discussion takes place among staff members of in-house GST team relating to preparation of tax invoice and related matters. Company is legally bound to raise tax invoice in Indian rupees only for its products exported in accordance with relevant rules, and foreign currency amount is to be converted into Indian rupees in tax invoice using RBI rate. That's not acceptable at all. Company is legally bound to raise tax invoice in Indian rupees as well as commercial invoice in foreign currency. Very true. This is what they are supposed to do actually, in accordance with relevant rules and procedures governing the transaction. Further, foreign currency is converted into Indian rupees in tax invoice by using exchange rate in accordance with exchange rate notification issued by CBIC relevant in relation to date of invoice. Very good. This answer is correct actually, because there is something called Rule 34, which clearly says that the exchange rate which will be applied will be CBIC rate. What rate will apply? CBIC rate, my dear friends. Are we getting clarity, everybody? Good. Next. Company is legally bound to raise invoice in Indian rupees only for products exported in accordance with relevant rules, and foreign amount is converted in Indian rupees using buying rate. Nonsense. Fourth opinion, company is legally bound to raise invoice in Indian rupees as well as commercial invoice in foreign currency, but we'll use selling rate to convert. That's not acceptable at all. Company has achieved export turnover of 50 crores during the year ended 31st March 2024. It has also created duty drawback from Customs Authority. Wow! Amounting to 2 crores in statement of P&L account. During the year ended 31st March 2024, company has incurred research and development expenditure of 10 lakhs, and the financial statement of the company reflected net profit of 7.5 crores. Net profit is there in the P&L account. Next. The in-house staff GST team, oh my God, if you observe, everything is related to taxation only. In-house staff GST team of the company was made in confusion from the very first month of export sales regarding discharge of GST liability on payment of IGST and refund issues. Already I told you this in simple language. Export sales had begun from October 2023 and made-ups valuing 5 crore were exported during the month of October, carrying GST rate of 5%. 5 crores, 5% is 25 lakhs, 0.25 crores. Breakup of ITC is inputs is given, capital goods is given, input service is given. You have got two options. Number one, export without payment of tax under LUT, where we don't pay the tax, but we'll claim whatever input credit we have got, entire credit I'll take it as refund. Correct, my dear friends? Second option, what they are? Come on, friends. Second option, what they are? Exports on payment of tax and whatever. Exports on payment of tax and whatever credit, whatever tax they pay, that entire tax they can claim it as refund. Very, very interesting point. There were divergent views among team members pertaining to discharge of tax liability. The overall GST liability of the company pertaining to supplies and export is 0.25 crores, and it would be discharged by availing ITC on inputs, and the balance would be discharged by company in cash. Why? I will take on inputs also, input service also, capital goods also. Overall GST liability of the company pertaining to supplies and exports is 0.25 crores, and what, my dear friends? I will use ITC on inputs, ITC on capital goods, and ITC on service. Balance would be paid in cash. And after discharge of the liability and filing of return, above said amount will be refunded directly into the bank account. 100% answer is correct. Next point. Option C. After filing of GSTR 3B and GSTR 1, we will get the refund. Good. Next point, what did they say? Overall liability is 0.25 crores. It will be discharged by ITC on inputs, capital goods, input services, and the balance in cash. And after discharge of liability and filing of returns, 3B, 1 and 9. So 9 is not relevant to claim the refund. 9 is only an annual return which is supposed to be filed. Next point. Overall liability would be discharged 0.15, 0.03, 0.02. And the balance will be paid by company in cash. And after discharge of liability and filing of returns in 3B and 1, said ITC amounting to 0.20 would be refunded. Why would 0.20 be refunded, sir? What refund you will get is entire 0.25. Whatever GST we pay, the entire GST will claim it as refund. Next. Company had imported a machinery worth 8.65 crore from South Korea, and the cost was CIF Mundra Port. CIF value is only the accessible value, as always you know. However, company had incurred 2.36 lakhs as clearing charges paid to DK Services Private Limited, including 0.36 lakhs on account of IGST, for availing services for getting consignments cleared from the port. Further, company has also incurred 3 lakhs on account of freight paid to D Transport Services, a proprietary concern. Freight charges is paid to GTA. This proprietary concern is not registered as a taxpayer under GST, and the company has deferred IGST on account of reverse charge. Very good. Further, company paid 1.77 crores to another company for providing service related to building construction, and 27 lakhs is on account of IGST. What a brilliant question, man. The crazy part of the question is, entire question is related to taxation. Got it? Did you like the question, first of all? Reply, my dear friends. Did you find the question interesting? You tell me that first point. Good. Some students are telling, if taxation, it is more wonderful. Oh my God. See the points. Which of the opinion given by staff members of in-house GST team regarding preparation of invoice for export transaction is most likely in conformity with legal provisions? I already gave this answer, my dear friends. They should ensure that they'll raise the invoice in Indian rupees and also export commercial invoice in foreign currency, and that is converted into Indian rupees using the CBIC rate. So definitely the answer is option 2 is correct, my dear friends. So what are the options we have? Option A, opinion 1, option B, opinion 2. Answer is opinion 2 is correct. Because as per rule 34, we have to convert using CBIC rate. Yeah. Case study 4, guys. MCQ 1. The whole point is tax invoice to be raised in INR, but commercial invoice to be raised in foreign currency. And the moreover, the interesting point is that, let me tell you, my dear friends, as per rule 34 of GST rules, as per rule 34 of what, my dear friends? GST rules. As per rule 34 of GST rules, my dear friends, it is to be converted into INR using CBIC rate. This point is very clearly given in the law, my dear friends. We should always use CBIC rate. This point is given by rule 34. My dear friends. So please speak out. You might get found out. Sir, CBIC rate, which date you will take? Will generally take on the date of time of supply. That is the answer generally. Are we clear with this? Can I proceed? Yes, thank you so much. Good. Let me move forward to the next question. Yeah. Second MCQ, my dear friends. Regarding tax levied to the company for the month of October under the provisions contained in GST law and rules, which statement is correct? Let me go back to that. This point we discussed. Overall GST will be 125 crores, and in that case we can take ITC on inputs, we can take ITC on capital goods, we can also take ITC on input services, and the entire 0.25 crores will take it as refund. So undoubtedly the answer is opinion 2 is correct. Come on, what are the options we have got? Opinion 2 is correct, 3 is correct, 1 is correct, 4 is correct. Answer is option A, my dear friends, because opinion 2 is correct. In case of export on payment of GST, we will pay the entire GST using ITC on inputs, ITC on capital goods, ITC on input service. And whatever we pay, that will claim it as a refund. Getting my point, everybody? Next. In the context of machinery purchase related transaction involving clearing charges, freight charges, discussed in para D of case study. What is that he's asking, my dear friends? Which point is correct? Let me go back to the paragraph. Yeah, see that. Company imported machinery worth 8.65 crore from South Africa, and the set cost of what, my dear friends? CIF set cost was CIF Mundra Port. However, they have incurred 2.36 lakhs as clearing charges, my dear friends. Whenever they incur clearing charges, it's a pure contract. On that, TDS will come under section 194C, my dear friends. Next. But I hope you guys already know that TDS to be done only on the base value excluding GST. Then they have also incurred 3 lakhs on account of freight paid to D transport services. On that freight charges also, my dear friends, TDS is supposed to be done under section 194C. Next, what else I told? Company has paid 1.77 crores in relation to building construction, and on that they paid 27 lakhs, my dear friends. Can they claim that 27 lakhs as credit? Come on, speak out, my dear friends. Undoubtedly, they cannot claim that 27 lakhs as credit. But whatever GST they paid on the freight charges and all, that they can take it as input tax credit. That they can take it as input tax credit. So my story of this whole question will be, the story of this whole question will be on clearing charges and freight charges. TDS will come under section 194C, and that too, my dear friends, TDS will come on the value excluding GST. On the value excluding what, my dear friends? GST. And the point is that GST charged on freight charges and GST paid under RCM can be claimed as input tax credit. But GST on construction cannot be claimed as input tax credit, because I hope you know that it is a block credit, my dear friends. It is very clearly a block credit given by section 17 subsection 5. Are we clear with that point? Everybody come on, please reply. Shwede asking, sir, is there necessary to pay RCM on freight to unregistered dealer? Definitely there is necessary. 100% RCM provisions will apply, my dear friends. There is no doubt about it. Yeah. Deduction of TDS under income tax law and availing of eligible ITC. ITC, what I'll claim is, my dear friends, ITC, what I'll claim is, 1 second, hold on. 36,000 I'll claim it as ITC, and 15,000 also I'll claim it as ITC. Total is 51,000 I'll claim it as ITC. So first option, 51,000, that is correct. Second, 36,000 is gone. Third, 2751 is also gone. Fifth one, 26, 27, 36 is also gone. Fourth one is also gone. So the only favorable option is first point, 51,000 ITC. And TDS, 3,07,000 is deducted. How did they get 3,07,000? Come on, my friends, how did they get 3,07,000? Can somebody please reply? On 2 lakhs, they'll do TDS at the rate of 2%. On 2 lakh, they'll do TDS at the rate of 2%. And on the 3 lakh, they'll do TDS at the rate of 1%. The reason, because as per section 194C, if receiver is individual or HUF, if receiver is individual or HUF, then TDS rate is 1%. And if receiver is other than individual or HUF, then TDS rate is 2%, my dear friends. Getting the point, everybody? Good. Student is asked one question. Sir, he is not registered in GST and not issued consignment note. Then why RCM? Sir, one point you have to understand, he is somebody who is engaged in transport services. And whenever we pay freight charges, my dear friends, on freight charges, that is GTA, reverse charge mechanism will always apply. If that person is unregistered, it doesn't mean that he will not issue a consignment note. Question is not talking about consignment note. Whenever question is talking about transport services under GTA, we always assume that consignment note is given, my dear friends. No doubt about it. Got it, my dear friend? Yes, my dear friend, please reply. Good, thank you. So answer is, which of the following point is correct? Combination of 1 and 2, that is only correct. Student asking, no sir, you did not get the logic. Okay, let me tell you once again, my dear friends, whenever we take service from GTA, recipient is required to pay tax under RCM. Do you agree to that point? Yes. Done? Yes. Now, when GTA is unregistered, then only we pay tax under RCM. If GTA is registered, GTA has got two options. Option 1, GTA can charge 12% under forward charge, or GTA can go for reverse charge mechanism, or GTA can go for 5% also. That option is also there. So GTA can choose forward charge, or they can choose reverse charge. If GTA goes for forward charge, they can pay 12% or they can pay 5%. If GTA goes for reverse charge, receiver is liable to pay tax under RCM. Now, student is asking, without issuing consignment note, how can we conclude it is a GTA? Sir, whenever payment is made to a transport services, my dear friends, we always assume that he gives something called consignment note. If the question is silent, we assume that it's a consignment note. And moreover, in the question itself, they told proprietary concern is not registered taxpayer and company has deposited IGST on reverse charge. That means company would have definitely got consignment note. When question only they told that company paid under reverse charge mechanism, why are we worried? Got it, my dear friend? I'm sure now you got the clarity at least. Sounds good? With assumption, I accept. So the assumption I have drawn from the question itself, my dear friend. You have to understand that in question only they told company paid tax under RCM. When question only they told company paid tax under RCM, that means consignment note would have come to the company. That's it. Done. Next point. Point number 4. Company is under statutory obligation to submit a documentary evidence regarding proof of import of machinery. What is the proof of import of machinery, sir? Proof is always a bill of entry. Option A, bill of lading, forget that. Option C, bill of lading, forget that. Option B, bill of entry. Option D is also bill of entry. Now, please read the 2 points and you please tell me which answer is correct, my dear friends. Bill of entry is a documentary evidence regarding evidence of import of machinery, and its copy is required to be submitted to the jurisdictional office of GST by the importer. But see the D point. Bill of entry is an appropriate document regarding evidence of import of machinery, and its copy is required to be submitted to the concerned branch of the bank through whom import transaction was channelized. Friends, let me tell you very clearly, my dear friends, it is the importer's responsibility to electronically file bill of entry, my dear friends. So, bill of entry is an appropriate document to establish a proof that goods have been imported. And let me tell you, my dear friends, we practically submit to the GST office. We do not go to the GST office and submit online. It is electronically filed with the customs department itself. The branch, my dear friends, branch of the bank through which it is channelized. And bill of lading story will come only in case of export transaction. So the answer is not option B, my dear friends. Answer is option D. Some friends have replied answer is option B, but let me tell you, answer is option D, my dear friends. Did you get that point, everybody? Come on, guys, kindly please reply. Good, fair enough, sounds good. Next point, fifth bit. Fifth bit is about Companies Act. Yeah. Descriptive question. Promoters of the company are law compliant and do not want to be seen on the wrong side of the law. However, they're also prudent minded and want to take tax benefit available legally and seek your advice. Friends, student is asking, sir, I did this with my client but confused. What you have done with your client? Which one you are talking about? Acha, you are telling that you actually done with that bank submission practically. Oh, but then I need to forget, my dear friend. Yeah, so they're asking, company wants to get some tax benefit. As I told already, my dear friends, there is something called section 115BAB for associates who are engaged in manufacturing and who have set up, the company has been set up and registered on or after 1st April 2019. But before 31st March 2024, my dear friends, then in that case, my dear friends, they can take this benefit of section 115BAB and pay tax only at the rate of 15%, my dear friends. And the company should be engaged only in manufacturing, but not into any computer software, mining and all this stuff. But once they choose that, they can't get additional depreciation, they can't get special deductions and all. Lot of benefits will not come, my dear friends. But the tax rate will be 15% plus surcharge 15% plus surcharge 10%, HEC 4%. And one special condition there they told is that imported second-hand machine is treated as new machine. And moreover, one more point they told in the section is, my dear friends, your old plant and machinery cannot be more than 20%. And in the question, if you remember, they told the old plant and machinery is worth 2 crores. And the total value is 10.65 crore. Total value is how much, my dear friends? I remember as 10.65 only. Let me check once again. Yeah, 8.65 is from foreign, 2 crore is from India. Total is 10.65. Out of 10.65, 2 crore is the old plant and machinery. That is definitely okay because 20% can definitely be old plant and machinery that will still work, my dear friends. So in this particular question, they can happily take the benefit of that section called 115BAB, my dear friends. But let me tell you one point very clearly that if you want to take that 115BAB benefit, you have to exercise that option and file a form within the due date of return of income. And in fact, there is one form called Form 10 ID, what you are required to file. So these are all points you can write. You need not anyways mug up because you are answering the case study based MCQ, which is an open book system. So not to worry at all. But you should only be in a position to identify which section you are talking about. Next. What else they're asking? Descriptive, advise promoters to lower its tax. Already I told. Company has made export made ups of 50 crore payment of IGST and they have availed ITC of 2 crores during 23-24. Now, what is that they're asking? Eligible ITC or inputs is 1.50, capital goods is 0.36, input services is 0.14. Discuss whether there was any other legally permissible way to export its goods, keeping in view provisions of GST law. Already I told you, you have got 2 options. Number 1, export with payment of tax. Number 2, export without payment of tax under LUT. If you are exporting without payment of tax under LUT, what will happen is you will get refund of only this 1.5 and this 0.14. But you can't take refund of 0.36. 1.5 plus 0.14 means 1.64 you will get refund. But if you are going for export with payment of tax, on 50 crores, you have to pay 5%, which comes to 0.25 and 0.25. And that 0.25, what will you do? Sorry, 50 crores, 5% is 2.5 you have to pay. That 2.5, you will pay 2 using credit ledger and 0.5 using cash ledger. But that entire 2.5, you can again claim it as refund. Because in case of export with payment of tax, you can use credit of ITC on capital goods also. But the only problem with export with payment of tax is that now you have to pay 50 lakhs from pocket. Because you have to pay 2.5 crores tax, no? 2 crore is the credit what you have. 50 lakhs you have to pay from pocket and then claim refund of 2.5 crores. So your amount will get blocked for some time. That is the only problem. If not, it's a fantastic thing. Next. Also make a cross comparison of export on payment of IGST versus other legally compliant way in terms of financial burden or benefit. I just told you that. That is the story. So if you ask me which one is better, I would always say with payment of tax is better if you have credit on capital goods. Because with payment of tax only, you can utilize the credit on capital goods. That's it, my dear friends. That's the story of this brilliant question. And I strongly believe that you got very good clarity on this case study. Clear? So with this, my dear friends, we are done with case study number 4, case study number 5, and I also discussed with you case study number 10, my dear friends. Clear? That's all, my dear friends. That's it for today's discussion. And in next session, we'll talk about much more interesting case studies very soon, and I'll come back with more interesting provisions of taxation. Clear? Thank you so very much, my dear friends. Take care. See you all very, very soon in the next session. Thank you. Shivateja signing off. Take care. Bye-bye. And tomorrow's details will update in the group. Don't worry. Thank you.
So we are taking up case study number 2 now. Next 3 case studies that we will try to cover today, they only have multiple choice questions. So it will be easy for us. Okay. So we are doing case study number 2 from the Institute's study material. Let's refer. So we have got question number 4 here. Okay. Let's read question number 4. Are you all with me? Are you all active? Just write a yes in the chat so I know you all are active. Very good. Okay, good. Let's read. Question number 4, case study number 2. The startup is planning to merge with another startup engaged in similar activities. Which of the following statement is in line with the provisions of law regarding proposed merger of these startups? What do you understand from this question? See, we understand that one startup is merging with another startup, and they want to know what is the correct procedure for merging up the startups. If you want to refer for more facts, if you want to refer to the case study, let's see. See, this case study is particularly talking about the benefits that a startups have in terms of income tax or Companies Act. Okay, now here, this particular startup's name is Growfin. Growfin is planning to merge with another startup company engaged in similar line of activity to increase its size, revenue, and scalability. However, the founders of the company are clueless regarding the modalities of the same under relevant law. Only this much is written in the entire case about merger of the two startups. You simply have to mention how the merger of the startups is done. So now, because this word merger has come up, definitely we are talking about the chapter relating to compromise, arrangement, amalgamation, and mergers. Okay, we are referring to that chapter. Simply go into that chapter and refer to which of the section is relating to mergers of startups. So we have got a very direct section, which is section number 233, which talks about merger of certain types of companies. Let's understand this provision first, then we are going to assess the options. Okay. Now, this section is a very long section. So it has a detailed procedure of how merger is done. So I'm going to quickly brief you through it. Okay, then you will select the correct answer for us. Okay, so see, this section number 233 talks about merger or amalgamation of certain types of companies. But what kind of companies are we talking about? Here, certain type of companies means 2 or more small companies, or we talk about holding company with its wholly owned subsidiary companies or other companies that are prescribed. Now, in the prescribed companies, 2 or more startup companies are also there. Okay, so if 2 or more startup companies are merging, we don't have to follow the long procedure which is mentioned in section 231 or 233. We simply have to do this easy procedure which is given in 233 section. Now, what does this section say? It says you have to follow certain conditions if 2 startup companies are getting merged. What are these conditions? First of all, a notice will have to be sent to the registrar of companies, the official liquidator, and any other person who's affected by the scheme. They will be asked to give any suggestions or objections. So first we are going to frame a big scheme that this is how we are going to do the merger. The scheme will be sent to these 3 people. If they have any suggestions, they are going to give the suggestions to us. Then after receiving the suggestions, we will put this scheme for approval in the general meeting. It has to be approved by 90% or more of the total number of shareholders, total number of shares. Okay, so 90% or more approval has to be taken in the general meeting. Once that is done, then we have to file a declaration of solvency with the registrar of companies. stating that, we are solvent, we will be able to satisfy our creditors, we have got sufficient money. This has to be filed with the registrar of companies. The next step is that we'll have to take the approval of creditors also. See, creditors will be affected by this merger, so we have to take their approval. Majority of the creditors, representing 9/10 of the value, they will have to give the approval. Okay, once their approval is also received, all these 4 steps are done. Then what will we do is, the transferee company is going to send this scheme to central government, and it is delegated to regional director, also the registrar of companies and the official liquidator. Okay, final scheme will be sent to these 3 people. Now the registrar of companies and the official liquidator, if they have got any objections, they want to make some changes, they will send those objections to the central government, which is delegated to regional director. Ultimately, all of this will go to the regional director. The regional director is finally going to approve the scheme if it is nice. If, on the other hand, if it is against public interest or creditors' interest, then it will be referred back to the NCLT to be considered under section number 232. Okay, so this is the broad structure. So we have to take so many different approvals. Now, based on this whole discussion that we've had, we have to select the correct answer. Let me just revise. First, the notice will be sent to registrar of companies, official liquidator, any other person affected. Their suggestions will be taken. Then general meeting approval will be taken, 90% or more. Then declaration of solvency will be filed. Then creditors approval will be taken. Then it will all be sent to central government, ROC and liquidator, official liquidator. Then the ROC and official liquidator will send any other suggestions to the central government. Finally, central government will approve or reject the scheme, send it to the NCL. Right? Now we have to select the correct answer here. Okay, so we'll have to read these 4 options to understand which one is wrong. Okay, let's see. So we're reading the A option. It requires filing of the proposed scheme with the NCLT. No, NCLT is nowhere in the fast track procedure. So NCLT option itself is wrong. Okay, this option number D also mentions NCLT. So this is also wrong. It requires filing of the proposed scheme with the NCLT and final order in respect of merger. So option D is also wrong. So we have to select one from B or C. Let's read. B option. It involves giving notice of the proposed scheme to registrar and official liquidator and approval of the scheme by both the companies. After approval of the scheme by the creditors, the scheme is approved by registrar of companies. Okay, so this looks little bit right and little bit wrong. Let's read the C option also. It involves giving notice of the proposed scheme to registrar and official liquidator. This is correct. Initially, notice is given. Then approval of the scheme is done by both the companies. Yes. After approval of the scheme, after approval of the scheme by the creditors are also giving the approval. The scheme is filed with the regional director, registrar, and official liquidator. The scheme is finally then registered by the regional director. So which one is correct? B is correct or C is correct? Which one is more elaborate? Both look correct, but this C option looks more elaborate and contains all the steps. See, initially notice is given, then members' approval is taken, then creditors' approval is taken, then finally it is sent to the regional director, registrar, official liquidator, and then finally regional director, that means central government, approves it. So the correct option is C. C is more detailed. So C is going to be our correct answer. Make sense? Make sense? Yes or no? Okay. So I need a yes from you all in the chat to understand that you are with me on this. You are able to understand. You're able to understand everything? Okay. Good, I'm happy. Chalo. So we are going to now move on to another case study. We've got 2 more case studies to finish in this session. Okay.
So without any delay, my dear friends, let's start the discussion. We'll talk about some very interesting point in case study 2 and case study 3 today and understand some intricate aspects of taxation with respect to direct and indirect tax laws. And I'm sure we are ready for the discussion. Kindly please reply. So friend, let me start the discussion. I'm going to talk about today case study 2 and case study 3, some interesting case study. Especially case study 3 has got so many interesting vital elements related to taxation, which we'll talk in detail. Come on, first let's look at case study 2, my dear friends. An article singing pians for India's space tech startups appeared in the New York Times recently. The article underlined that India has become home to many such startups Nowadays, there is a lot of discussion that is happening around startups. And I'm sure you guys know this point. And let me also tell you one point very clearly. Under income tax law, we have got one beautiful section called ATIAC. And that section gives income tax exemption to startups. And moreover, my dear friends, to highlight you one point very clearly, let me tell you, they give an exemption of 100% of profit. For a period of 3 years, we can take exemption of 100% of profits. 3 out of first 10 years, we can take exemption. And the exemption is 100% of profits. And that is allowed only to those startups which are incorporated on or after 1st April 2016, but before 1st April 2024. But let me also highlight you, my dear friends, the interesting condition what they put in the law is that their turnover should not exceed 100 crores. In the previous year, in which we are planning to take that deduction, turnover should not exceed 100 crores. And practically, let me also tell you, there is one board called Interministerial Board of Certification. They actually give the approval for the approval of startups. And the startup should be registered under that interministerial board for the purpose of claiming exemption. Clear? Proceed. It pointed out that space technology is fulfilling smaller scale and commercial purposes, like helping farmers in timely assurance of their crops. Space technology is also helping commercial fishing fleets in tracking their catch by sending images back to the Earth. Wow. Satellites are bringing home signals to countries' remotest corners and are helping in operation of solar farms far away from India's mega cities. It is also one of the India's most sought after sectors for venture capital investors. Next slide, my dear friends. Startups are mushrooming in different sectors of India's economy as varied as education, health, agriculture, fintech, clean energy, electrical vehicles, biotechnology, waste management, food processing, and even drones. So in various sectors, the startups are flourishing like anything. Next point. Economic survey for the year 22-23 highlights that by capitalizing on the digital infrastructure support, India has also emerged as one of the world's most vibrant destination for startup ecosystem. Startups are being envisioned as the spine of New India. In fact, India is home to world's third largest startup ecosystem. So whatever we discussed till now is all about boosting India as to how startup economy system and startup ecosystem is blooming in India. Now comes the real story. Growfine, that is our particular SSC in this question, is an edtech startup incorporated as a private company in April 2023. The founders of the startup believe that some benefits are available to startups under income tax law. However, they are unaware about nitty-gritty of the same. That means the positive and negative shades of the same, as they are from engineering and management background. Company has launched its products in 23-24 itself and had a turnover of 20 crores. As long as turnover does not exceed 100 crores, they can happily take that ATIAC deduction. It is recognized by DPIIT, that is Department for Promotion of Industry and Internal Trade, under Ministry of Commerce and Industry, and holds a certificate of eligible business and is recognized as technology-driven startup by the competent authority. So it is very clearly a technology-driven startup, and it holds approval of DPIIT, which stands for Department for Promotion of Industry and Internal Trade. Growfine has issued shares to certain investors who are familiar with founders of this edtech startup. They believe in the business idea of the founders of the company and have decided to invest money out of their own sources. So basically, they are planning to make money from investors, and technically, the people who first invest in the company, they are technically called as angel investors. What do we call them? Angel investors. These investors are wedded to idea of providing quality, affordable education to all and promoting standards of education in the country. In this way, their ideological belief stands aligned with the mission of founders of startup. Wonderful. The startup Growfine has issued equity shares having face value of 10 per share to this individual at 50 per share. That means 10 rupees face value share is given at 50 per share. The moment you read this line, you should be able to recollect some section called 5627B, which says that section applies only to a company in which public are not substantially interested, technically called as closely held company. And if that closely held company is issuing shares at a price more than fair market value, and in fact, at a price more than face value, this section will apply, and the difference between the fair market value and the issue price, that will become taxable. And in the question, if you see, face value is 10 and the shares are issued at 50, and the fair market value is 11 rupees per share. So the share which is 11 per share is issued at 50 per share. Next slide. The existing paid-up share capital of the company is 1.5 crores, and the company has not issued shares at premium at any time in the past. So for the first time, they are issuing shares at premium. Profile is still in nascent stages. However, it has already launched its products and entered a segment of the market. So what we're discussing very clearly, that this Growfine entity have never issued shares at premium, and for the first time, they have issued shares at premium. So the moment shares are issued at premium, my dear friends, what will come into picture is section 5627B will come into picture, where section applies to a closely company, and that too section applies when shares are issued at a price more than face value, and the taxability is on difference between issue price and fair market value. Growfine is still in nascent stages. However, nascent means initial stages. However, it has launched its products and has entered a segment of the market. Then, the market has a considerable potential for companies' business to grow. Startups not only need finance, but they also require favorable and conducive ecosystem to grow. It includes not only hand-holding at the time of germination of business idea, but also policy measures having a legislative backing. In India, relaxation and benefits have been provided to startups under various laws like Income Tax Act as well as Companies Act. Growfine needs talented and skilled employees for its business. However, company is not in position to pay high cash salaries to attract and retain employees. It is therefore considered the route of ESOP. I'm sure you guys know very clearly that a lot of companies at the initial stage and nascent stage, they will not be in position to pay too much of cash salaries to employee. And when they are not in a position to pay too much of cash salaries to employee, for example, if employee deserves 30 lakh as salary, they will tell 10 lakh will pay as salary, balance 20 lakh will give share. Because tomorrow when the valuation of the company grows, you will get 2x, 3x better revenue than this. That's called ESOP. Employee stock option plan provides a chance to the employees to become shareholders in the company and also benefited by its future growth. Company plans to draft an ESOP scheme containing matters relating to grant of option, vesting period, and the manner of determining exercise price, among others. Company is approaching many talented persons for assuming various senior roles in its organizational setup. One such senior person, Mr. X, has shown interest in joining the company. However, he is skeptical regarding income tax implication pertaining to ESOP. So what? We are there to explain. He has a doubt it may lead to withholding of tax by startup, impacting his immediate cash in hand salary. In case of startup, TDS will not be done right away. There is a deferment of TDS. Growfine is planning to merge another startup. When we talk about merge, we are not concerned with taxation. Next, valuation, that's not anything to do with tax. Next point. From the description given in case study relating to finance brought by individual, which type of financing is referred to? That's not related to tax. Next point. The founders of Growfine believe that some benefits are available to startup. Considering the description provided in the case study, which of the following statement in accordance with provisions of income tax law that is true, my dear friends? So let me tell you very clearly what is the interesting point is that company, as I told you, for a period of 3 years out of 10 years from when startup is incorporated, they can take 100% deduction. It is 3 out of 10. First option, 5 out of 10, not possible. Second option, 3 out of 10, that's a correct option. C, 5 out of 10, that's not okay. D point, 3 out of 10, that is also important. But in B and C, the difference is that B point, certificate of eligible business is provided by Inter-Ministerial Board of Certification. Here they told certificate is provided by CBDT. CBDT is absolutely not okay. because certificate for eligible business is given by Interministerial Board of Certification. Very, very interesting point, my dear friends. There is no doubt about it. An interesting issue which a student should definitely get a clarity upon. And let me also clarify you very clearly that this concept is given by section 80 IAC. Which section, my dear friends? Section 80 IAC. Come on. Let me share the Excel. I'm sure Excel is visible to you, my dear friends. Case study 2. MCQ number 2. That is, my dear friends, deduction under section 80 IAC is allowed to a company incorporated. What is that line, my dear friends? To a company which is incorporated on or after 1/4/2016, but before 1/4/2024, and it is somebody, it has obtained certificate from Interministerial Board of Certification. Very, very interesting point. And the exempt deduction, what they get is, for a period of 3 years, out of 10 years, 100% of profit is allowed as deduction. Very, very interesting point, my dear friends. For a period of 10 years, for a period of 10 years, for a period of 3 years, they can take deduction of 100% of profits. But the interesting point is that turnover does not exceed 100 crores. This is an important issue. Turnover does not exceed what, my dear friends? 100 crores. That's also an important point, my dear friends. This is one very, 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 very interesting point that they have given in the law. Just a second. Let me save this file. That's it. That's the story of this very, very interesting, my dear friends. Clear? So that's the reason my answer is option B. Next. As regards to doubt of Mr. X regarding withholding tax in relation to ESOP is concerned, which of the statement is appropriate? First of all, let me clarify you that withholding tax. So let me tell you. MCQ number 3 only, right? Yeah. So let me tell you very clearly, my dear friends. TDS in case of salary is given under one brilliant section called very clearly here, that which says that in case of ESOP, that too in case of startup, my dear friends. I repeat once again, in case of ESOP, that too in case of what, my dear friends? Startup. I repeat once again, in case of ESOP, that too in case of startup. Tax is payable within 14 days from earliest of following. Earliest of following is number 1. 48 months. What is the number 1, my dear friends? 48 months. Or let me write like this. After expiry of 48 months from the end of assessment year. After expiry of 48 months from the end of assessment year. Second one, from the date of sale of such shares. From the date of what, my dear friends? From the date of sale of such shares. So whatever shares that employee has got, he has sold that shares. Third point, from the date of leaving the job. That is technically called ceases to be an employee. Ceases to be an employee. So within 14 days from earliest of these date, my dear friends, within 14 days from earliest of these 3 dates, he is liable to pay tax. So my dear friends, let me tell you very clearly, it is not that TDS is done starting itself. TDS is deferred. So what is it they asked? As regards to what, my dear friends? Doubt of Mr. X regarding withholding tax in relation to ESOP is concerned, which of the following is statement is correct? Income tax would be withheld at the rates in force when option is excised. Not at all correct. Company is an eligible startup holding certificate income tax is not to be withheld. Oh my God, crazy point. C point, company is eligible startup holding certificate of business. However, startup is allowed to defer withholding tax when option is exercised and the shares are allotted to X, and it is deducted in required manner after expiry of certain timelines and happening of events. Wonderful. So the answer is very clearly option C, my dear friends. Option C. So withholding tax is deferred. Very, very interesting point. Next. Fourth bit, merger. That's not related to tax. That's related to law. Fifth bit is about strategy, valuation. That's not related to tax. Come on, descriptive question. First bit. Grofine has issued equity shares to individual having face value of 10 rupees per share at 50 per share. What are the income tax implications for the same? And what is such tax commonly and popularly known as? I already told that's called angel tax. Under which circumstance they can claim exemption from tax? Wow, very, very interesting question, my dear friends. Let me answer that to you very clearly. That is, as per section 56 to 7B, if the shares are issued at premium, then the difference between issue price and fair market value is taxable. If the issue price is more than the face value, if the issue price is more than what, my dear friends? Face value, then what is going to happen? The difference between issue price and fair market value, that is going to become taxable. And this section says that this concept is given by section 56 to 7B. And let me tell you, this concept is actually given under income from other sources. And such tax is called angel tax, my dear friends. And exemption is allowed to startup. Exemption is allowed to what, my dear friends? Startup. Exemption is allowed to startup provided they are recognized by DPIIT, Department of Promotion of Industry and Internal Trade, my dear friends. Very, very important point. And second important point is aggregate of, what is that line, my dear friends? Aggregate of paid up share capital and securities premium. I repeat once again, aggregate of what? Aggregate of paid up share capital and securities premium, also called as share premium. After proposed issue, aggregate of paid up share capital and securities premium after proposed issue, my dear friends, does not exceed 25 crores. This is one very interesting point what they have given, where they clearly told aggregate of paid up share capital and the security premium, also called share premium, after the issue of shares does not exceed 25 crores. That's one very, very interesting line. Got the point, everybody? And they should not use that money, my dear friends, for the purpose of buying land and building and all. They should not use that money for the purpose of giving loans and advances. They should not use that money for the purpose of buying motor vehicles, for the purpose of jewelry. So all those things they cannot do with that particular money. Very, very interesting concept, my dear friends. There is no doubt about it. I'm sure we are getting complete clarity on this point. Very, very interesting case study. And that's the end of story of this beautiful case study number 2. And second case study is all about due diligence that has got nothing to do with your taxation related elements. So that's the story of this interesting case study, my dear friends. Case study number 2, which I'm sure you got a very good clarity, my dear friends. Kindly please confirm that you are clear so that I can happily proceed, guys. I love the participation. Your participation makes us feel good. So please keep participating. Please keep replying. Thank you.
Hello, everyone. Good evening. Am I audible? Can any of you type something? Okay. Hi. So, guys, so if you have any message, please bring it in the chat for all. Then also, if you're sending me any DM, send it to the host ID. Don't send it to, the where my video is visible. I'm logging through 2 devices. So please send in there. Then just one sec. Just close this. Yeah. So today we're going to be covering AFM related topics. So we will be covering, let me just share my screen. Yeah. So we'll be covering 3 case studies specifically. One is May 22 case study. This is pertaining to May 22 exam. The case study is, I think, case study number 3. This is let me just open it. There's a problem with my system. I had to restart it, which is why all pages went away. Yeah, one is BMY LLP, which is case study number 3 of May 22 question paper. Then you have November 23 question. This from November 23 paper. And in this, the question is, I think if I'm not wrong, here the question is, also I think it is 3 or 4. One sec. It's not GK manage. I think it is 4. SAK, yeah, case study number 4. Then we have case study number 2 from ICI latest study material. So I am making the full screen visible so that you can see. We are going to start first with this case study 2, which is called Grow Fine, which is from the ICI study material, latest new syllabus material. Okay, so and I'll also solve this some of these questions through Excel, because there is nothing major in any of these. These are very, very simplistic stuff. So if you're able to see my screen, or if you believe there is any issue with the screen, please ping me on chat. I'll be more than happy to increase size or zoom in or anything like that, whatever is required. Okay, so feel free. Now, let us first go with the Grow Fine case study, which is case study number 2 from new syllabus material. So as we usually do, we first go and look at the questions. Only then we come back to the thing about reading what are the relevant paragraphs of the case study. Okay, this is the logic you have to follow, and I'm pretty sure all the other faculty have also been telling you the same thing. So first question is, from the description given in the case study relating to voice is echoing, is it? Just hold on. Are others also facing that thing? Somebody's complained that voice is echoing. If anybody else is also facing, let me know. Or voice is echoing, is it? Okay, just hold on. Is it better now, or is there any other, is it still echoing? Can you please respond again? Is it still echoing, or is it better now? Better now. Okay, great. Fine. So my bad, I think there's some issue with the microphone. Anyway, let's move forward. The question is, from the description given in the case study relating to finance, brought by individuals from their own resources and whose belief in promoting affordable education to all in the country and also improving its standards is aligned with the mission of founders. Which type of financing for a startup is being referred to? This is extremely clear. I mean, I don't think we even need to go back to the question case study, but let us see. From the description given, finance brought by individuals. Please note the word individuals. If you want me to zoom in, I'll zoom in further. Right? Finance brought by individuals from their own resources. So individuals are bringing own resources whose belief is in promoting affordable education. I don't know what the case is. Okay. And also improving its standards. So basically, they have some mission. Which type of financing is for a startup is being referred to here? Is it bootstrapping? Is it venture capital? Is it funding by angel investors, or is it factoring? So we will go back to the question and then go back to the case and then look at it. Answer is no, it's not bootstrapping. Let us see. Let us see what it is. It is by individuals. Okay. Yeah, it most likely is angel. Let us see. Let us see. So space tech, they've said something about space tech, space technology, satellites are bringing and all of that. So they've given a lot of stuff about satellites and startups are being envisioned. So now here comes the key thing. GrowFine is an edtech startup. If I highlight it, you're able to see it properly, or if I don't highlight, you're able to see properly. Let me know, no, please, what you want, because if it is not visible, if I highlight, then I will not highlight. It's fine. Okay. It's a startup. They believe that some benefits are available to startups under Income Tax Act. However, they are unaware about nitty-gritty of the same. The company has launched its product in the year DPIT, so on and so forth. They have issued shares to investors who are familiar with the founders of this edtech. They believe in business idea. They have issued shares to certain investors who are familiar with the founders of this edtech. They believe in the business idea. They means the investors and of the company and have decided to invest money out of their own resources. These investors are wedded to the idea of providing quality, affordable education to all and promoting standards of education in the country. In this way, their ideological belief stands aligned with the vision of the founders of the startup. It is very, very clear. Bootstrapping is what? Bootstrapping is when the founders themselves either put in their own money, or bootstrapping actually means you are generating money from your startup and then you are reinvesting it. Right, that is what actually bootstrapping means. Okay, so yeah, so bootstrapping basically means using your own money to and growing without taking any external funding. This is with respect to an investor. So there is absolutely very clear that there is external funding. Now, is it venture capital financing? Venture capital financing is done by VC firms, and they look purely for profit. They also need to understand the idea, agree with the idea, align with mission, but there is no emotional connect, right? A VC is a financial investor. Here, it is very, very clear there is an emotional connect. Then you have funding by angel investors. This is absolutely the right answer. There is an emotional touch or an emotional connect, and they believe in the founders. So VCs also, believe in founders, but as financial investors. The angel investors believe in investors because they are either friends, family, like the idea, they want to do something, and so on and so forth. And then there is factoring. Factoring is basically discounting of receivables. So that is not the case. So the answer for this is very, very clear. Funding by angel investors. All right. Anyone has any query or doubt, please ask. I'll be more than happy to respond. Then co-founders believe some benefits are available to startup. This is an income tax question. So I will leave this particular question on income tax. Next is also about withholding tax and ESOPs and all of that. That I will not cover. Shivtej will be covering that. It is not already covered. Then there's a question on NCLT. Okay. So NCLT is also a law-related question, not related to us. Now, see this question. Which of the following is not a factor to be considered for valuing a startup like GrowFine? Now, for us to understand this, we have to first go and understand about GrowFine more. So let us go and see what GrowFine is doing and all that. GrowFine, is an edtech startup. It's a incorporated as private limited company. Then we read about what is their idea. They have issued equity shares. They have some fair market value. GrowFine is still in nascent stages. It is still a very small company. However, it has already launched its products and has entered a segment of the market. The market has a considerable potential for companies' business to grow. Startups not only need finance, but they also require a favorable and conducive ecosystem. It includes not only hand-holding at the time of germination of an idea, but also policy measures. GrowFine needs talented and skilled employees for its business. And then they've explained about ESOP. Then they say, this all thing is about ESOP and income tax. So I'm ignoring that because you would have already read this particular point by the time you've reached there. GrowFine is planning to merge with another startup in a similar line of activity to increase its size. However, founders are clueless regarding the modalities. Valuation of the startup is often required for bringing in investments. The value of the startup is dependent on its future growth prospects. It is also quite likely that such a business idea has never been tested before. It only lies in the realms of the future. Realms means, somewhere far ahead in the future. Another problem in startup valuation is totally new or non-comparable business products and strategies. Startups also depend upon many rounds of funding. GrowFine may also approach another set of investors for further rounds of funding. So based on all of this, these are the only relevant aspects where they've discussed about funding. So now come back to the question number 5. Which of the following is not a factor? Please note, this is a negative question. What is a factor? What is not a factor? Is past performance a factor? Maybe, may not be. Educational qualification? Maybe, may not be. Uniqueness of the product? Maybe, may not be. Traction? Maybe, may not be. Now you see, what are the key things to note here? First of all, it is a very small startup. It is in very, very nascent stages. The angel investors invested money in it, believing the founders. Okay, they have a grand vision. They're an edtech startup. They want to do something very, very big. All of these mean what? It means it's a very, very young startup. A very, very young startup which does not have any financials, which is recently created. How will you evaluate that startup? Based on the educational background of the founders. Yes, the promoter background, education, non-education, their pedigree, or somebody from IITs, IIMs, or ISB, or things like that, right? That is one. Second, what they have done in the past. What is their drive? All those get into valuing a startup. No, these are all very subjective criteria. Even then, valuation exercise is also about all of those. Uniqueness of the product. Yes, it is a very young, new product, but then it is a unique product. Then you have traction. Traction means growth. Traction. The word traction refers to growth. Is the product growing or not? Yes, all these three are considered. But there is no past. Why? Because the company is just started. The startup has just been incorporated in very, very nascent stages. So past performance is not a factor or not a criteria used for evaluating a startup like mine. What is the criteria? Criteria is the background of the founders, uniqueness of the products, and growth or traction. Right. So please note, very, very careful. If you have not read this word, gone. Whole question is gone. You have to be very, very clear, very, very careful what you're reading. You have 3 hours, 4 hours, whatever the time is there, it is there. Aram se, go through, underline things, and read what is there in the question properly. Okay. So this is the second one. Let us check the answers. So no, there is one more question. GrowFine is issued. What are the tax implications? Tax implication, I'll not get into it. Sriteja will get into it. Is also planning to approach other investors to fund its business. What specific points shall be considered while carrying out due diligence of the startup for picking up an additional equity interest by a prospective investor? Very good question. Let's assume that I am GrowFine. I am coming to you. What are the key questions or points that you will ask as a potential investor to me, saying that, why should we invest in you? That's a question you will ask. So what is the due diligence you will do? It's an interesting question. What are the things that you will do? Let me write this down. Right. GrowFine. What are the things that you will ask? You will ask me, what is the product? Product explanation. Right. Then what is the market? Right. What is the market size? Then there is something called as TAM, TAM, total addressable market. What is a TAM? Right. Correct. Funding vision. No, funding, they're asking you to give the funding. No. So funding so far. What is your vision? What is the founders stakes? How much stake all of you own? Then who are the key founders? What is the rest of the team? Right. Then background of founders, background of initial employees. Right. Then product testing. That is called prototype. Customer feedback. Right. Then valuation. So you see, even though when you're trying to value, so this is one thing. As an investor, when you're trying to value, you will also ask the other party, what do you think is your valuation? You may not, it is generally whenever. So I've been in a lot of these pitches, and I've pitched for my own company. I was pitching for multiple other companies where we were trying to raise money. They will ask you, what is it that your startup is worth? How much stake do you want to give? And for that, how much money do you want? What is your ask? They will what is the ask? But that is not a due diligence aspect, but I'm generally telling you that they will ask. So these are the kind of questions that they will ask. This is the kind of things that they will get into to figure out whether they should make an investment. They will also ask about competitor product. Right. So they will ask about all of these things. Right. So TAM is total addressable market. So I'll tell you what is. So this is actually there in my AFM. I've actually given a pitch deck of Sequoia. You can actually go and Google for a sample pitch deck of Sequoia. Sequoia is the world's leading VC investor. They're world's #1. They've been there they've invested in Google, they've invested in WhatsApp, they've invested in Facebook. They're there in every large big tech company and non-tech companies also, right? So their pitch deck, sample pitch deck is available online. Just go and Google what Sequoia's pitch deck, sample pitch deck, you'll get it. There you will find out a lot more of this. But I will explain to you what is TAM. TAM is, let us say I am starting in EdTech. Now, what is the total EdTech market? EdTech market in India is all the students. Now, the students can be kindergarten, they can be primary, they can be secondary, higher secondary, they can be professional courses, all of that, right? Now, this is the total market. In the total market, what is the addressable market for me? So, if I am launching courses for CA, then the addressable market for me is students of BCom, students of commerce colleges, and students of people who are already, let's say, finished CA foundation or CA intern and only CA final level. So all these people are my addressable market, right? Now, in this addressable market, there is, again, you will, these out of these people, if let us say I am offering a product which is only for CA final, then the addressable market comes down further. Let's say I'm offering a product only for CA foundation, then my addressable market comes down. So total addressable market is what is it for that your sector or your your product that you're offering. What is the addressable market? How much can you address? Whom can you sell it to? Overall market is for the entire EdTech as a sector as a whole, right? Similar to target market. Absolutely, Mohit Bashi, similar to target market. What is your target market or target group? Correct, right? So these are the questions that this is the due diligence that you will do before making an investment, right? Now let us go back to the question. What is the first question answer is angel investors. Right. Answer is angel investors. They've given a reason also. Why is it angel investors? So that answer is right. Then coming to next question. See 5A. In a valuation of a startup like Find, there is no historical data. So valuation of a startup rests on future growth potential. So answer is A. We are right. What is not a factor? Past performance is not a factor. Okay. Then coming to the next question, which is last question about due diligence, right? Which is what we just discussed. A prospective investor shall carry out due diligence before picking up equity invest. Background of the promoters, I told you. Credentials. It is necessary to verify startups' claims regarding growth and numbers. The prospective investor should be convinced about the business model and type of service. The startup should be differentiated to meet customer requirements. Besides, they should show potential to scale up in future according to the suitable business plan. The prospective investor also would look for market size and obtain and likely obtainable market share and macroeconomic drivers for this market. Extent of competition in the market in this segment also needs to be looked at. Nonetheless, they would also be looking at exit avenues. This is one thing I didn't write. They would also be looking, how will you exit? I made an investment. See, in a stock market, if I buy, I can sell in the market. Whereas if I invest in a private company, which is not listed, whom will I sell it to? So a bigger player needs to be there, or can this be IPO? So that also is a very important factor. Good point, actually. Exit avenues. Right. The investor would also be taking into account fact whether a startup is showcasing potential to future acquirers or alliance partners. It's a valuable parameter for the investor. Subsequent rounds of funding and acquisitions are all examples of exit options. Subsequent round of fundings. So why do they say that subsequent round of funding is an exit? Can anybody answer that? Why is subsequent round of funding an exit opportunity? Nobody is responding, so I'll take it up. So when you invest in a startup, when let's say I'm a VC and I'm investing in a startup, I am a seed investor. Seed means I invest at the seed stage. As the company grows, right, I will exit. I will not be there till the end. In some cases, I may choose to be there in the end. But if I believe that the company is not doing well, because I'm there from seed stage, so I know the company very well. The next investor who is coming, he may have a different view. I am under no obligation to to explain or do due diligence for other investors. Other investor has to do his own due diligence. So when a new investor is coming in at Series A or Series B or Series C, they tend to buy out seed investors. They tend to buy out angel investors. They tend to buy out Series A investors. Right? They may not. So if I am investing in a company as a seed investor, if the company goes out and does an IPO, I can sell my shares in the market. The company is acquired by somebody else, other competitor. Let's say an academy acquires Byju's. I'm just giving an example, right? And it's, Byju's investors have got an exit. Or if I have initially invested in a company and then subsequently Sequoia is coming and investing in the company. Sequoia says, I don't know all these chukku seed investor, angel investors. Please sell your stake to me. I will invest 100 rupees in the company. I will invest 10 rupees by buying out all these initial investors. So they will buy out all the initial investors. So next subsequent rounds of funding will have secondary exits. That is, instead of exiting in the primary market is the stock market. The secondary market is the market where you sell to another investor. So exit avenues can also be evaluated if there are subsequent rounds of funding. Subsequent rounds of funding happen, you may sell it off to a new incoming investor. Okay, so this is the other question that we have. This is the 3 questions that we have in this grow fine, right? So grow fine is one thing, and here, see guys, I have written about 12 or 13 things. I don't know the count. My suggestion is, even though the answer is given in paragraph form in the institute material, my suggestion when you are asked what are the parameters, please write in bullets. And please write as many bullets as possible. If you know 10, write 10. If you know 15, write 15. Even if 1 or 2 of them are wrong, no problem. But write more. So what will happen is, you will also know what you're writing. The evaluator also will know, this fellow has covered, or this girl or boy, whoever it is, has covered all the points. Right? Please write it in bullet forms. I know most of you already know it, but just for the sake of my reconfirmation, I'm telling you this. Right? So this is grow fine. This is done. Okay. So I'm closing out grow fine. Anyone has any questions, please ask. Otherwise, we are moving to the next particular case study. Okay, in these case studies, subsequent case studies, there are some mistakes here. I felt very bad and looking. Okay.
Good evening, everyone. We'll wait for a minute or so. Others are joining. Otherwise, we'll start. So today we'll be taking up a case study number 11 onwards from the new material that ICAI has released. Okay, so we'll start with whoever has joined. So today, as I just told, we'll continue from case study 11 onwards. 11 we'll do it towards the end. First, we'll cover up FR related part of other case studies. So let me just share my screen. So this is case study number 12. Is my screen visible? I guess yes, it's visible. Okay, so here again, the way we have been doing, we'll quickly jump into what are the issues, quickly having an understanding. So they have given issues. So whenever you have issues specifically, some or the other question would be, coming up, right? So it says company is operating in 50 countries and the customs exchange rate, bank buying rate. So again, the reason to read this first and last line is to get a gist of what is being asked in the question. So here more likely or most likely, it is something to do with customs or GST, right? So that is the first thing. Then second issues, one of the overseas subsidiaries has provided financial assistance to WTL. Financial assistance is outstanding in the books as foreign currency loan and TDS is applicable, all of that is given. Then company has to comply with listing obligations. So this is related to your SEBI LODR rules. Woman director. So if you see in a lot of case studies, woman director, small shareholders, those aspects have been pretty much considered. So have a good recap of this. AVER was required by WTL and the same was accounted as a business combination as per Index 103. So we have been getting questions on 103, Index 110. Then we had questions on Index 36, which is on impairment, right? Then we had questions on leases, revenue. These standards become more important whenever it, as far as the case study is concerned. So we'll come back depending on the question what is to be discussed. Now, first, this is with respect to GST, so we'll keep it aside. 3CD of Income Tax Act. Audit committee should be reconsidered. So this is something to do with law. Woman director, again related to law. Customs, so that is related to customs. Then implications of GST. Then issue 5, compute the value of options under the share-based payment as per Index 102. Now, when we were reading the question, just a second. There is some network issue, looks like someone has messaged. Is there a lag or let me just switch the network. Okay. Just give me a moment. I'll try to set it right. I hope it's slightly better. Or are you still getting the lag? I'll erase it, Faiz. No need to worry. Are you still getting a lag? Okay, so what I'll do is to preserve the bandwidth. I think there is some issue with internet. I'll turn off my video so that the lag will be reduced slightly. Once the network connection gets better, we'll do it. Okay. Sometimes what happens is because it's summer time and sometimes you have this issue of computers and all getting heated up. So I'll turn off the video. Right. Okay. Now, so as per issue 5, what they have asked is what is the value of options under India's 102? Now, that is the reason why I tell you that every time you don't need to, look into depth of what is the question. So question has asked us what? Question has said it's a business combination. Now, the moment we see business combination, if you come to issue 5 and India's 102, that strikes your mind. But then there is an existing share-based scheme in our private limited with a vesting condition for 4 years, in which 3 years had already lapsed at the date of acquisition. WTL agreed to replace the existing award for the employees of the acquired entity. Fair value of the option under the share-based payment scheme on acquisition date was 1200. Fair value of option replacing the existing scheme was 1500. Only 1 more year was left for vesting after the acquisition. So this is a case where we do not follow the guidance under or the accounting under India's 102 whenever there is a replacement award, and if it is a business combination, we have to see what part should be allocated to pre-acquisition period and what part should be allocated to post-acquisition period, right? And based on that, we have to do the accounting for it. So basically here what has happened is Aver Limited was acquired. Now, when Aver Limited was acquired, Aver Limited had given their existing employees saying that 1, 2, 3, 4. If you work for 4 years, you will get certain options, right? Certain options will be vested. Now, what has happened? In year 3, after 3 years have been completed, so this portion has been completed, 1 more year is left. And what they have done is, they have replaced this award. Means, whatever Aver Limited has given to its employees, what WTL is saying now is, forget whatever Aver has given, we will give you fresh awards. WTL will give you fresh awards, and we have the fair value of both the cases, 1200 of existing award and 1500 of the new award. Now, for the new award also, what the question has said is, for the new award also, what the question has said is, 1 year is left. Okay, 1 year is left. So how should we account, or how should we account this particular thing? That is what we have to consider. So first we'll quickly have a look at what India's 103 talks about it. So here, if you see acquirer SBP awards, exchange for awards held by acquiring employee, meaning to say acquirer SBP awards, whatever is the acquirer SBP, they are whatever they are awarding in exchange. Okay, now how should we account for it? An acquirer may exchange its share-based payment awards, replacement award for awards held by employees of the acquiree. Okay, then the share-based payment awards will include vested and unvested shares. So here we have vested and unvested, where they are saying that 3 years is done, 1 year is left. Whenever we have exchanges of share options or other share-based payment awards in conjunction with the business combination, they are accounted for as modification of share-based payment awards in accordance with India's 102 share-based payment, right? So what we will do, we will consider that this is a modification of existing awards. Now, if the acquirer is obliged to replace, then we will see what is the pre-combination service. Pre-combination service means service prior to combination or some service prior to business combination. The amount pertaining to this is purchase consideration, and post-combination service, that is whatever has been given new. So in our example, whatever we have discussed, at the end of year 3, we gave something new. Okay, now the value of new minus whatever is the pre-combination service, minus whatever is the pre-combination service, that is considered to be the post-acquisition expense. Okay. Now, how do we calculate that? You will take the original fair value, you will multiply with the vesting period completed. So, original fair value given is 1200, vesting period completed is 3, and higher of total or new vesting period. Total vesting period is 4 plus 3 plus 1 4, that is 3 of completed, 1 of new. New vesting period is year 1 year that is left, correct? So what you will do, 3 divided by 4, this 900 is considered to be pre-combination service. Now totally new value given is 1500. 1500 minus 900, 600 is considered to be post-acquisition service. So that is how we have to account for it. How will we do it? Whatever is the original value and how much ever vesting period has lapsed. So coming back, original value was 1200. For this 1200, 3 years has already passed by. So 1200 into 3 divided by 4, 900 pertains to the pre-acquisition period. Out of this, in place of this 1200, we have given something worth of 1500. 1500 minus 900, 600 becomes your post-acquisition vesting. So that is how it will be accounted for, right? So in you have to present that answer in that way, where you say pre-acquisition period is 3, post-acquisition period is 1. Total fair value on at the acquisition date is 1200. Divide by 4 into 3. How did we get 4? This is the 4 because of the total vesting period. Okay. Divided by 4 multiplied by 3, 900. Value to be recorded as per Ind AS 102, 1200. Divided, sorry, as per 103, 1200 divided by 4 into 3. That is 900. And value to be recorded as per Ind AS 102, that is the total value is 600. You can directly present it this way. No need to split between this component and this component, that is not required. After you have calculated 900, you can directly do fair value of new minus pre-acquisition. That is 1500 minus 900, it is 600. So that is what, or that is how you will be accounting for it. So this presentation is better, you can follow. Okay.
Let me proceed to the next interesting case study, my dear friends. That is about case study number 12. Friends, can I proceed? Please reply once. Thank you very much for the cooperation. Come on, see that, my dear friends. Case study number 12. Wanton Terun Limited is a fast-growing listed company focusing on innovation in textile and garment industry. Company has grown in the last 1 decade from Punjab to the homes of millions of customers across 50 countries, across various countries they are dealing, and is aiming the target of becoming the most trusted brand that takes conscious care of its customers, employees, and all stakeholders, and treats them the best. Company also has 5 subsidiaries operating outside India in the same line of garments and trading of some special types of yarns. Financial statements of the company for 23-24 have already been prepared, and the audit was completed as per all regulatory requirements. Next one. After gaining experience as CFO, company has 5 subsidiaries operating outside India and the same line of garments and trading of some special types of yarns. Financial statements are prepared and audit was completed. After gaining experience as CFO of company WTL for the last 15 years, Terun has resigned and started his own venture in the professional consultancy with some other players in the same business domain. Management gave an advertisement in all leading newspapers for highly qualified professional for the vacant post of CFO. 50 applications were received by the company, and all the candidates were competent and had good exposure in various aspects of the company. All that is story. management of the company decided to have interview board for selecting the appropriate candidate. After looking at the recent development in various areas relating to operation of the company, accounting and other technical aspects of Companies Act, following issues were selected on which opinion of all the candidates was sought, and whosoever gives the correct response will be selected for next round of interview. You're also interested in this job profile and have been asked following issues during the interview. Wow, let's see that. Company is operating in 50 countries. So the employees of the company travel worldwide to oversee the operations and for business expansion. And for this purpose, foreign currency is taken from authorized dealers who charge GST as per relevant provisions of GST law and applicable valuation guidelines, and used for meeting all overseas expenses, including stay, travel, and food expenses. For the upcoming business trip, employees will be traveling to USA and they require $10,000. Company purchased $9,900 by paying 7.4 lakhs. However, customs exchange rate and the bank buying rate on the same will lead to 7.45 lakh and 7.5 lakh respectively for equivalent number of dollars on the same date. On the same date. So they clearly gave the rates of what, my dear friends? They gave the rates of customs and they also gave the rate of bank. Are we getting clarity, everybody? Friends, come on, please reply. Good. Next, let me proceed. During the last overseas visit of Senior Vice President, company received an export order for different types of garments, for which yarn was required to be imported. Company imported a special yarn from Germany for manufacture of garments. There was no transaction value available for such yarn. Consequently, value of identical goods was considered. Very good. One of the overseas subsidiary, Triple S Inc., has provided financial assistance to WTL. Very good. That means Indian entity has taken loan from their associated enterprises. The said financial assistance is outstanding in the books of accounts of the company as foreign currency loan, on which it paid interest of 32 crores. But let me tell you, there is one brilliant section called 94B, which talks about thin capitalization norms, which says that whenever an Indian entity is taking loan from an associated enterprises and you pay interest, that interest what you pay cannot exceed 30% of EBITDA. EBITDA means earnings before interest, taxes, depreciation, and amortization. The amount of TDS has been deducted and deposited within the due date. Profits before interest, tax, depreciation, and amortization, EBITDA of the borrower the previous year was 100 crores and the depreciation was 15 crores. Next. Company has to comply with listing obligation and disclosure requirements. That's related to directors. Next. Women director, that's related to law. Ever Private Limited was acquired by WTL and business combination India is 103. That's related to your FR. Come on, multiple choice question. In respect of purchase of foreign currency from authorized dealer, whether the GST will be applicable? If yes, what will be the value of service on which GST will be applicable as per Rule 32(2)A? Which rule, my dear friends? Rule 32(2)A. Good. Let me tell you very clearly, my dear friends, what they told in the law as per Rule 32. What they told in the law is, my dear friends, value of supply is 1% of consideration charged. And we'll use RBI rate. That too we'll use what, my dear friends? Buying rate. We are going to RBI rate. We are going to use RBI rate, my dear friends. And of course, it could be buying rate or it could be selling rate also for that matter, depending upon what transaction we are doing. Getting my point, my dear friends? Come on. What is the currency as purchased, my dear friends? Sir, tell me, sir. Let me go back to the question. In the question, they gave customs exchange rate and they gave bank buying rate. That means what? RBI rate is not available. Friends, speak out. Hold on for a second. Bank rate is given. Okay, let me write properly here. So let me explain you very clearly here. As per Rule 32, my dear friends, what it says is value of supply is difference between RBI rate and the rate at which transaction is done. That will be the value of supply. But they told in the law that if RBI reference rate is not available, then the value of supply will be 1% of consideration charged. That is the provisions of Rule 32, my dear friends. Come on, speak out, my dear friends. Getting clarity, everybody? Friends, come on. Here in this case, if you observe, how much dollars he has taken? He has taken $9,900 by paying 7.4 lakhs. $9,900 have been purchased by paying 7.4 lakhs. 9,900 divided by 7.4 lakhs is paid, no? 7,40,000. So technically, he purchased at 74.74, my dear friends. Friends, come on, please reply. He purchased at 74.74. I hope we are clear, my dear friends. Done. Very good. Now, what is the bank exchange rate they have given in the question? What is the bank exchange rate they gave? Let me go back to the question. Hold on. So if you see here in the question, foreign currency is taken from dealers, and for the business trip, they require $10,000. Okay. And the company purchased foreign currency, $9,900 by paying 7.4 lakhs. That means technically for them, the price which has come is 74.74 per dollar. Correct? And customs exchange rate and the bank buying rate on the same day will lead to 7.45 lakhs and 7.50 lakhs. Now, what is that you are going to do, my dear friends? Tell me. Tell me, my dear friends, what is that you are going to do? Now, bank buying rate is nothing but, if you would have purchased from bank, how much you were supposed to pay, my dear friends? You would have paid something called 7.5 lakhs. You would have paid something called 7.5 lakhs. So the bank buying rate will be 7,50,000 divided by 9,900, which is 75.75, my dear friends. And the difference is technically 1.0101. Are we getting clarity on this point, everybody? All of us, come on, please reply, my dear friends. That is the bank exchange rate. Then, after that, my dear friends, value of supply will be, how do we calculate value of supply, my dear friends? this into 9,900. I hope we are getting clarity, my dear friends. And GST at the rate of 18%. That's it. That is how you do the working for this kind of question, my dear friends. Are we getting clarity on this point? Everybody, please reply. Come on. Some student is telling screen is not visible. Is it still not visible for you? And you have to understand that the bank exchange rate is what we have to consider as RBI rate. In fact, let's look at the question once again. Hold on. I'll explain the point once again. Don't worry. Hold on, my dear friends. Sir, first point, if you see, they use the line. Wait a second. They use the line something like this. For the upcoming business trip, employees will be traveling to United States of America and they require $10,000. That means actually they want $10,000. And company purchased $9,900 is what they purchased by paying 7.4 lakhs. 7.4 lakhs they paid and they purchased $9,900. That means technically they bought it at the price of 74.74. However, customs exchange rate is 7.45 and bank buying rate is 7.5. In the question, they have actually not given what is the RBI rate. What is the RBI rate exactly? That is not being given in the question. You're getting my point, what I'm saying, my dear friends? If the question is not giving RBI rate, then what is that we are supposed to do then? Tell me. See, technically, what is the difference we are going to take? We are going to take RBI rates. We are going to take RBI rate and the difference between what rate we purchased, that difference will be taxable value of supply. But in the question, the problem here is buying rate, selling rate we have. Buying rate, selling rate we have got. What is that? 7.4 lakh we paid to get $9,900. It is nothing but we purchased at 74.74. And the RBI rate is not available in this particular question. Are you getting clarity on this point, everybody? So you can treat the bank exchange rate itself as RBI rate. Are we clear? That's an assumption what we have considered. Student is telling options are different. Let me see the options. On what assumption they went, let us see. GST will applicable on these services and the value of service will be 7,450, 7,400, 5,200. GST on transaction below $10,000 is specifically exempt. No. D option is not at all correct. D option is not at all correct, my dear friends. D option is not at all correct. So that means, my dear friends, what is that we can do is, instead of doing that, now let's derive the answer from the options itself. That is, let us say, in question, RBI rate is not given. Okay? RBI rate is not given. In that case, my dear friends, value of supply will be 1% of consideration. Correct, my dear friends? Value of supply is what? 1% of gross amount. 1% of what, my dear friends? Gross amount. What 1% of gross amount? 7,40,000 into 1%, which comes to 7,400. And GST at 18% will be 7,400 into 18%, which comes to 1,332. I think now your option will match. So if we are taking that scenario, my dear friends, The answer will be option B, my dear friends. See, if you assume the bank rate as RBI rate, then story is different. If RBI rate is not available, then the story is different. So using my options, I derived the logic here. Are you getting my point, everybody? Brilliant question, guys. Brilliant question. This is how they try to test your brain in various angles. Very, very interesting question, actually. Yeah? Good. Next question. Question number. Case study number 2. Second point, I mean to say. With respect to facts given in issue 2 above. What was the issue 2? Let me recall. Issue 2 is about that thin capitalization. We have taken loan from foreign. Correct, no? Then. Interest to be reported by tax auditor under Form 3CD. Very good, my dear friends. In fact, my dear friends, there is a clause known as clause 30B of the tax audit report, which talks about 94B, my dear friends. 94B. And what is that we are going to report, my dear friends? What is that we are going to report, my dear friends, is basically how much is allowed, how much is disallowed. So clause 30B is the clause under which we are going to report, my dear friends. They're asking 30B means A or B, 30 crore and 2 crore. No, answer is 32 crores and 2 crores. 32 crores and 2 crores because 32 crores is what they actually paid. But out of that, 2 crores is not allowed. Out of that, what, my dear friends? 2 crores is not allowed. Why 2 crores is not allowed, my dear friends? 2 crores is not allowed for a simple fact and reason that maximum allowed under section 94B. I repeat again, maximum allowed under section 94B is only how much, my dear friends? Come on. Maximum allowed on 94B is only how much, my dear friends? I already told you. Friends, come on, please reply. Maximum 94B is only 30% of EBITDA. And 30% of EBITDA is only 30 crores. I'm sure we are clear with this. Good. Let me check if I have a PDF format of Form 3CD so that I can discuss that, open that and show you once. Just 1 second. Fine. I'm unable to get that form. Let's ignore that. Yeah, student is asking some question. What is it he's asking? Sir, EBITDA 30% is 48.6. How did you get that 48.6, my dear friend? You have to see that in the question. In the question, profit before interest, tax, depreciation, EBITDA figure is 100 crores. Depreciation 15 crores. We will always see the figure before depreciation. We'll always see the figure before depreciation, my dear friends. So EBITDA figure is how much, my dear friend? EBITDA figure is 100 crores. Out of that, 30% is 30 crores. Got it, my dear friend? Yes, my dear friend. Can I proceed? Please reply. Yeah, thank you so much. Good. Love the participation. Very good. Let me proceed. So answer is option B, my dear friends. 32 and 2 crores. Next point. Third question related to audit committee. So we are not concerned. Fourth question, woman director, not related to tax. Come on. Fourth question, my dear friends. Which of the following statement is correct in relation to import of what, my dear friends? In relation to import of what? Yarn, for which transaction of identical goods is considered. Sir, always, my dear friends, in case of identical goods, we'll always see it same commercial level, and that too substantially same quantity. This point is given by Rule 4 of Customs Valuation Rules, which clearly says when you take identical goods value, please see it same commercial level. that too at substantially same quantity. Logical point, because if you compare the price of wholesaler with retailer, that's not proper comparison. And you are importing 10,000 quantity, other person is importing 1,000 quantity. How can you compare the price? In order to compare, they must be comparable. So the answer will be option C, my dear friends. Sale at same commercial level and substantially same quantity. Very, very interesting point related to customs. Good. Descriptive questions. Mr. Q, before accepting appointment as director, discuss with company about the implication of GST on appointment and emoluments. Explain if service provided by directors are under ambit of GST. Straight answer, my dear friends. If he is an employee, service by employee to employer during the course of employment on the GST will not apply. If he is not employee, my dear friends, GST will apply. GST will apply. And moreover, if he is not an employee, GST will apply. That too, GST is required to be paid under reverse charge mechanism. Getting my point, everybody? Good. Student is asking, sir, can you please calculate 94B limit using previous question? Sir, please understand, 94B limits, sir, I repeat once again, 94B basically talks about your thin capitalization norms, which says that whenever you take loan from outside India, from your associated enterprise, to that associated enterprise, we are paying interest. Correct? And law says that interest what you are paying, excess interest will be disallowed. And excess interest will be interest which is beyond lower of 30% of EBITDA or the actual interest, whichever is lower. In the question, the actual interest is how much? Come on, you please tell me in the question, what is the actual interest they gave? Actual interest they gave is 32 crores. And what is 30% of EBITDA? 30% of EBITDA is only 30 crores. So how much is allowed is only 30 crores. How much is allowed is only 30 crores, my dear friends. When it is only 30 crores that is allowed, what is going to happen is very clearly 2 crore is disallowed. Basically, this concept is applicable only when an Indian company is taking loan from a foreign company, which is associated enterprise, and to them, they are paying interest. And interest is more than 1 crore rupees. Then we'll apply this provision. That please don't pay interest more than 30% of EBITDA. And if you're paying more than 30% of EBITDA, that excess figure we will disallow. That's the whole logic. I hope you got clarity, my dear friend. 100% is before depreciation and interest. 100 is before depreciation and interest. Correct, you are right. I will look at EBITDA only. No. EBITDA is what? Earnings before what? Interest, tax, depreciation, amortization. Before only I'll see. Why would I see after depreciation? Depreciation is not considered. Correct, not considered only. I will not consider also. Because I will say 30% of EBITDA. EBITDA means what? Earnings before interest, tax, depreciation and amortization. Before figure only I'll see, not after figure. Already given EBITDA 100 crores. Yes, they only give 100 crores EBITDA. Directly they gave depreciation figure only to confuse you, which is not relevant for us. In question, they directly give 100 crores of EBITDA. Nothing to calculate also. Now clear. Thank you so much. Happy that you got clarity at least now. Yeah, let me get back. Now, this point is over, right? That is GST in case of directors. Descriptive, my dear friends. First point, service by employee to employer in the course of employment is neither regarded as supply of goods, nor regarded as supply of service. As per section 7(2)(a), read with schedule 3, my dear friends. However, if director is not an employee, then it would be taxable, and moreover, it will be taxable under RCM. Moreover, it will be taxable under what, my dear friends? RCM. That means who's liable to pay GST is the company, because services by director to body corporate is covered under RCM. I'm sure majority of you know this answer. Good. Next. 7th bit in the facts compute value of option under Ind AS 102. That's related to FR. That's all. So that's the story of this interesting case study number 12. A very short case study, but an interesting case study, my dear friends. No doubt about it. Are we clear with these points, everybody? Can I happily proceed, my dear friends? Thank you very much, my dear students. Love the participation.
Now we'll move on to the next case study, which is case study number 12. So regarding the upcoming sessions, see, I will be taking sessions on alternate days. Like today I've taken the session, next session I'll be taking on Saturday, and next session I'll be taking on Monday. And we'll try to cover up a lot of case studies in these 3 sessions. I'll basically try to cover up at least the company law case studies, majority of them, in the next 3 sessions. That means today, Saturday, and Monday. Okay, after that, for the next 10 days, I won't be available. All right, so just wanted to give you an update. The next 12 days, other faculties will be covering up these case studies. Okay. Okay, now in case study number 12, we have got fourth MCQ. Okay, now let's read this MCQ. WTL shall appoint another woman director on the board of the company on or before. Then we have got 4 dates available here. So here we are talking about woman director. This company has to appoint another woman director before a certain date. What is that date? So we need to have some facts. Let's look at the question. Let's directly try to locate where they are talking about woman director. So issue number 4 talks about it. Let's read issue number 4. So Arunima is a woman director in this company. Now, due to other engagements, she tendered her resignation before from directorship with effect from 1st March 2024. So this 1st March 2024 is the effective date of her resignation with effect from 1st March 2024. Section 149, correct. Okay, now wide letter dated 15th February. So the letter that she sends, that letter is dated 15th February, which was received by the company on 20th February. Now this letter was received by this company on 20th February. So she has given this letter beforehand. She's given it on 15th February and the company has received on 20th February. But this resignation will be effective on 1st March. Before that, she's still going to hold the office, she says. Now, the board took note of the resignation in the meeting on the 15th of March. So that means board conducted a meeting on this date and they considered this resignation. Okay. Now, based on that, by what date? See, there is this woman director. She has left the office. So therefore, there is a casual vacancy in place of this woman director's post. So we have to fill this place out, right? Okay. So here the relevant section is section number 149. So we are going to see the provisions relating to woman director first, and then you will have to answer the question. Okay. So see, section 149 talks about the board of directors and the composition of the board of directors. It says that prescribed companies should have at least one woman director. Now, what are the prescribed companies? The prescribed companies are given in rule number 3 of the company's appointment and qualification of directors rules 2014. These prescribed companies are listed company. That means all listed companies, they will have to have at least one woman director. And second, any other public company where the paid up share capital is more than equal to 100 crore rupees, or the turnover is more than equal to 300 crore rupees, right? Now, in case there is an intermittent vacancy, that means there's some vacancy between the term of the woman director, then it has to be filled within 3 months of that vacancy date, of the resignation date, or the immediately next board meeting, whichever is later. All right. So let's try to do some calculations. We have got 3 months or immediately next board meeting, whichever is later. Up till that date, the company will have to fill up this position. So let's see here. When did this lady resign? This lady resigned on the 1st of March. So 1st of March is the resignation date. So that means 3 months from 1st of March. That is going to come to 1st June. March, April, May, June. 3 months. That is one date we have. The other option is the next board meeting. The next board meeting happens on the 15th of March. Whichever is later. So 15th March or 1st June, whichever is later. Which is later? 1st June. So our correct answer is going to be 1st June. Till 1st June, this company has to appoint the next woman director. Okay, so can we select the answer? WTL shall appoint another woman director on or before 1st June, 20th May, 15th June, 15th May. The correct answer is A. Perfect. Okay, good. Now let's move on to the next case study. Easy questions, no? Simple questions, no? Company law questions are generally simple. Also, this today, particularly the cases that I am taking, they'll be mostly MCQ based. So that today's session will also be basically comparatively easy.
Okay, so let's go to the next case study. This is case study 12. So case study 12 has a question based on LODR, SEBI LODR regulation. So we'll first have a look at the question and then we'll go to the case study. So the question is question number 3. In the background of circumstances discussed in issue 3. So we'll have to read issue 3 in order to answer this particular case study. The company secretary contends that the audit committee should be reconstituted even if Q is appointed as an independent director. Is the company secretary's contention appropriate? So there is some audit committee which has been formed and there's some reconstitution of audit committee which the company secretary is contending. Now we'll first have to look at the case study and understand what the situation is, and only then we can answer this question. So let's go and read the case. So it is issue number 3 which is being discussed about here. So it says issue number 3 here says that company has to comply with listing obligations and disclosure requirements relating to corporate governance, and for this independent and a qualified audit committee is already formed and functioning. So there's already an audit committee which is formed and which is functioning. This audit committee consists of 6 directors, with 4 of them being independent directors. So there are total 6 directors in the audit committee, and out of 6 directors, 4 are independent directors. Now you all must be knowing that in an audit committee, 2/3 of the directors shall be independent directors. And one of the directors, who is Mr. P, who was an independent director, he is resigned as director of the company. So there was one director of the company who was resigned as the director of the company. So WTL proposes to appoint Q as an independent director who is already serving as a managing director in one company and independent director in 3 other listed entities. So what has happened here? There was an already constituted audit committee which had 6 directors. However, one of the director, Mr. P, who was an independent director, he has resigned as the director of the company. Now, there's a proposal which has come up which says that now another person, Mr. Q, has to be appointed as the independent director. And this person, Mr. Q, he's already serving as a managing director in one company and independent director in 3 other listed entities. Now, for your information, WTL here is also a listed company. So let's now have a look at the regulation. Let's now have a look at the provision, and let's then answer the MCQ. So the MCQ here is asking us that the company secretary who is contending that reconstitution of audit committee is required, is the reconstitution required? Yes or no? So the first point here can be answered directly, and that is yes, reconstitution of the audit committee is required. Why is that so? Because one of the independent director has resigned, which means that now there has to be 2/3 majority of members as independent director in an audit committee, wherein that requirement will not be met. And for that, the reconstitution of the audit committee would be required. So let's see the provision first, and then we'll come back and answer. So it says every listed entity shall constitute a qualified and independent audit committee, and the audit committee should have minimum 3 directors as members. So the minimum number of directors in an audit committee is 3, and at least 2/3 of the members shall be independent directors. And in case of a listed entity which has outstanding SR equity shares. Now, SR equity shares are basically equity shares which have superior rights. Superior rights means what? Now, have you heard of DVRs? Have you heard of equity shares with differential voting rights, DVRs? Yes. Now, what happens in case of DVRs? There's a diminution in the voting right. Generally, 1 share is equal to 1 vote. But in case of DVR, what happens? 1 share is not equal to 1 vote. Rather, it is lesser than a vote. So similarly, there are some equity shares which are issued with superior voting rights as well. That is SR equity shares. Now, what happens in case of SR equity shares is basically these shares would have 1 share not is equal to 1 vote, but it may be so that 1 share is equal to 2 vote or 1 share is equal to 5 vote. So there is a superior voting right which those equity shareholders have. And in case there is a listed entity which has any outstanding SR equity shares which have been issued, then the audit committee shall comprise only and only of independent directors, and it should not have any other directors. Basically, it should be formed only by the independent directors. Have you understood the difference between DVRs and SRs? Is this clear? Is the concept of SR clear? Yes? Okay, so let's go back to the MCQ and answer it. Now, before answering the MCQ, let's first see if there are any outstanding superior right equity shares. Is there any mention like that in this particular case? Let's just quickly have a glance at it. So you see, every issue talks about a different thing. It's about GST at places, it is about other aspects, other technical aspects. However, there's no mention of equity shares or superior right equity shares anywhere in the case study, which means that here the requirement is at least 2/3 of the directors should be independent directors. So, what do you think should the correct answer be? You give the answer to me. You now know what the provision is. You now know what the concept is. So, you tell me what should be the correct answer for the question number 3. Option A. What does option A say? It says contention of company secretary is correct, and the audit committee should be reconstituted as it should have at least 2/3 of the majority of members as independent directors. Now that one independent director has resigned, the number of independent directors comes below 2/3, so now it becomes important that the audit committee be reconstituted and there should be at least 2/3 of majority of members as independent directors. So the correct answer here is option A. Now, let's just quickly have a look at the other options as well. So option B says that the contention of company secretary is not correct. So no, that's not right. The third option says the contention is correct and audit committee shall be reconstituted with wherein it should have only independent directors. So no, this is not a company which has outstanding SR equity shares. So this option cannot be right. Option 4 says it is not correct and audit committee need not be reconstituted. So option 4 again is not correct. However, here in this situation, if there would have been some SR equity shares issued, then what would have been the correct answer? If there would be some SR equity shares, outstanding SR equity shares, in that situation, what would the correct answer be? Option C, correct. So option C would have been the correct answer if the equity shares would have been SR equity shares. Okay, clear? Have you understood this? Yes or no? What do you want me to repeat? You want me to repeat the last point? Had the equity shares been SR equity shares, that is equity shares with superior rights, outstanding superior rights equity shares, then in that situation, since WTL is a listed company, the audit committee shall consist of only independent directors as members. So in that situation, the correct answer would have been option C. Okay.
We'll be taking up case study number 10 now. Okay. In this case study also, we have got two questions which we are going to be considering. One is a multiple choice question and another one is a theoretical question. So first we are going to be reading the question and then we are going to see the facts and the provision. Okay. So let's read. So question number 4, I'm reading from case study number 10. Okay. Considering the facts of issue 4, is the appointment of Hero as the director of the company valid? Okay. So now just by reading this point, we can say that we have to read issue 4. So going back into the case is divided into issue 1, issue 2, issue 3, issue 4. So let's read issue 4 and let's see what is this saying. Basically, the question read, is Hero's appointment as a director valid or not? Okay, so let's read this part. Company at its annual general meeting held on the 30th September 21 appointed Ghana as a non-executive director on the board of the company for 3 years. Okay, so this person, Mr. Ghana, is appointed in the annual general meeting for 3 years as a director. Now, on 2nd October 2021, Ghana met with an accident and died on the spot. So see, 30th September, he was appointed and on 2nd October, he has died. Okay. So basically, the director could not complete the term of 3 years and within 3 days, he has passed away. So there is a casual vacancy that has arisen. Okay. Now, the board of directors of the company on 16th of October appointed Mr. Hero to fill the casual vacancy so created. Appointment of Hero was made for the term of 3 years by the board of directors unconditionally. Just give me 1 second. Just give me 1 second. So the board of directors of the company on 16th October appointed Mr. Hero as a casual vacancy for the casual vacancy so created. The appointment of Hero was made for the term of 3 years by the board unconditionally. The next general meeting is held on the 29th of October. So what happens? Original director dies and therefore the board of directors have appointed Mr. Hero as the director. Okay, they have filled the casual vacancy. And this person is appointed for 3 years. So is this appointment correct or not? So see here, the relevant section is section number 161, which talks about casual vacancy of the director. In case the director could not for any reason complete the term for which they're appointed, and in between, they leave or they die. It is called casual vacancy. How is it filled? It is first of all filled by the board of directors, and then subsequently in the upcoming general meeting, a resolution has to be passed to complete the appointment of the casual vacancy in place of casual vacancy. All right, so that means these two requirements are there. First of all, board of directors should approve, and secondly, in the general meeting also we have to take the approval, right? Okay, now what is the term for which the casual vacancy is valid? See, casual vacancy, the term is that, the original director, for as much as time that this original director was appointed, the same exact tenure is going to be applicable for the new director who fills up the casual vacancy. So see here, the original director, Mr. Ghana, was appointed for 3 years, and within 2-3 days he dies. Then Mr. Hero is appointed. He's also appointed for 3 years. So can we say that this appointment for 3 years, can we say that this 3-year period is correct? Just this part. Is this 3-year period correct for Mr. Hero? See, when a casual vacancy is filled, this provision says, okay, wait. You're saying no, but rethink about the answer. See, what I'm asking is, Section 161 lays down the tenure for which the casual vacancy is filled. Here, I'm only talking about the tenure. Mr. Hero is appointed for 3 years. See, when a casual vacancy of the director is filled, then the tenure is the same exact tenure of the previous director. That means this director will also expire. His tenure will also expire exactly when the previous director's tenure was supposed to expire. So Ghana's tenure was supposed to finish within 3 years. And this Hero is also appointed for 3 years. Do you think this tenure is correct? Only this tenure, not the appointment. Okay, so the tenure here is correct. 3 years tenure is correct. Appointment procedure maybe is not right. Okay, here what has happened? This company has only passed a board resolution. They have not taken any ordinary resolution. They have not taken this matter to the general meeting. Okay, so now overall, let's check whether Mr. Hero's appointment is valid or not. Now overall, please tell me, is Mr. Hero's appointment valid? Is only board resolution sufficient? Yes or no? Yes or no? No. Correct. Absolutely correct. No. Okay, so let's select the correct answer here. So we'll read the options. A says the appointment of Hero by board resolution is not valid as it is against the provisions of the Companies Act, and he should have been appointed by the members in the extraordinary general meeting. Okay, let's read the second option. Appointment of Hero by the board is not valid, but should be approved by the members in the general meeting held on 29th of October 2021. Okay, now these two options look very similar, don't you think? Let's read the third option. Appointment of Hero by board of directors is valid as the approval of the shareholders is not required. This is wrong option. We need the approval of the shareholders. Next option is appointment of Hero by board of directors is not valid as the directors cannot be immediately appointed in place of director who expires. Again, this is also wrong. From first A and B option, we have to select. See, A option says the appointment of Hero by board is not, okay, so it is not valid as it is against the provisions of the Companies Act, and he should have been appointed by the members in the extraordinary general meeting. See, this and this point look a little similar, but because here we have got specific date for the next general meeting in which the approval is required, therefore the more appropriate option here is going to be B. B is correct. All right. Okay. So that was our first MCQ. We are going to move on now to the next question. The next question here we have is 8th question. Now 8th question is a little bit more general question. Half of the question is very general. It requires you to just basically think. Okay, let's see. We are going to read the question and let's see if this question requires us to read the case study or not. Let's see. So question number 8, I'm reading. This is case study number 10. The executive and non-executive directors have different roles and responsibilities. The responsibility of independent directors with reference to financial reporting and approval as part of the audit committee requires a special mention. Explain with examples. Okay. So they have given a statement and they want us to explain this statement. So do you think this statement requires us to read the case study? Not really. We can simply see these particular statements. We'll have to break down this statement and understand what this question is wanting us to answer, what this question requires from us. We need to understand the need of the question. We don't need to see the case study here. And then accordingly, we'll answer. See, it says the executive and non-executive directors have different roles and responsibilities. This is first statement. Explain this. So that means first part of the statement wants us to explain the role of executive directors and non-executive directors. You simply have to mention what is an executive director, what is a non-executive director, and they are different from each other. So you'll have to kind of differentiate them. That's the first part of the question. Please understand what the question wants you to answer. Don't just directly, start rambling, whatever. Okay. The second part of the question, let's read. The responsibility of independent directors with reference to financial reporting and approval and part of an audit committee requires a special mention. So the second part of the question wants you to explain the role of independent director, but not just generally. It wants you to explain the role of independent director in terms of the audit committee, not just generally. Okay, so these are two parts of the question that you will have to explain. Once you understand this, then it's an easy answer to give. Okay, when we say audit committee, you directly have to refer to section number 177. And you have to mention the roles that are mentioned in the audit committee. The roles of the audit committee. See, audit committee, majority of the audit committee is independent directors only. So whatever is the role of the audit committee is also the role of the independent directors. So you just have to mention all the roles that are described in section number 177. And then, of course, first part of the question is you'll have to explain what is executive director and non-executive director. You know what is executive director and non-executive director. It's not specifically defined in our act. You understand? So I'm going to just directly refer to the answer and we'll quickly go through the answer. So we know directors, so here I have written it in bullet points, but you will have to elaborate it nicely. Okay, so you'll have to explain that, the company has got two types of directors. They are executive directors and non-executive directors. When we say executive directors, that means these are the people who are actually working, actually engaged in managing the business operations. You'll have to use this terminology. Okay, for example, we have got the whole time director and the managing director. These are two types of executive directors. Then other than executive directors, we have got non-executive directors. Now, non-executive directors, they do not actively participate in business operations, but they do attend board meetings. So they participate in the decision making of the company. Whatever policies the company is formulating, they are part of that. So we can say that independent director can be one kind of non-executive director sometimes. Okay, not always. Professional directors, some of the directors who are professionally qualified, they are part of non-executive directors, nominee directors, etc. Right? These are some types of non-executive directors. Right? Then you will have to mention the role of independent director in terms of audit committee. So then you will have to refer to section number 177. Okay, say that now section 177 specifically says that the audit committee comprises of majority of the independent directors. Now, what is the role of audit committee? The role of audit committee is with regard to the auditors, they recommend the appointment of the auditor, what will be the remuneration, what will be the terms of appointment of the auditor, they recommend that. Then they also check whether the auditor is independent or not, he's nicely performing his duties or not. They also check the audit report. They check whether the financial statement has been properly prepared, whether the audit report has been properly prepared or not. Then they also check the related party transactions. Okay, so you'll have to mention all of these points in this answer. And you'll have to say that that's the role of the independent directors. Okay. Is this clear? Tell me yes or no. You understand? So you see here directly a section is not used. Are you able to understand this answer? If this question comes in the exam, you will be able to handle it. Yes or no? Yes or no? Yes or no? Yes or no? So Deepika says yes. Only Deepika can handle. Rest of the students. Okay. So we are going to be moving on to the next case study now. Okay.
Good evening, everyone. So we'll continue with the case studies as discussed in the previous class, the remaining case studies. You already had some discussions on law, taxation. So today I'll be covering the FR part and audit part wherever applicable. And again, we will come back to the taxation part, which will be taken tomorrow. Okay. Notes for law will be uploaded by tomorrow. And then subsequently we'll be uploading notes for India's. So we'll continue from the case studies that were left for FR and all of that. Now here in today's session especially, we will be focusing on a lot of theoretical aspects because the questions are also directly related to theory. So when you carry the FR notes in the examination, you will be able to copy it from the notes directly. So that should not be a problem for IBS. That luxury you don't have in financial reporting. Okay, the questions has been asked in that way. So let me just share the screen and let us discuss the questions. So this is case study number 10. Okay, and this is about someone who has been an MBA graduate and they have set up a company. Father has set up a company by the name Sahana Fashions. That is the background. And again, as per our strategy, if you just look at the main headings here. She reached out to her old friend Madan, a practicing chartered accountant, to seek help on accounting and compliance matters. Okay. Madan set up his own proprietorship firm and has been practicing in audit and taxation since 10 years. Right. So that is about their interaction. And then the issues. First is not computing depreciation appropriately. The issue has been highlighted. So whenever these kind of issues are there, we can expect that some question related to the issue will be tested in the examination. Right. Then issue number 2, they acquired 100% of Spun Limited for 5 lakhs, which was into cotton spinning business. Fair value of net identifiable asset was 4.5 lakhs. Goodwill was 0.5 lakhs. On 31st March, government changed its policy on textile sector, having adverse impact on the business. So this is to do with the moment you hear these terms, right? Net identifiable asset, business combination comes into picture. Okay, so that is what is given. We will come back to this again when the question, if at all there is a question related to that. Then you have an issue of managing director and AGM, and then advised on individual tax matters as well. Okay. Now, question first is related to taxation. Second, what is the amount of impairment loss which Sahana Fashion Limited is required to transfer to statement of P&L? And how the same should be allocated. So here, what is the question asking us? The question is asking us, what will be the impairment loss that you have to transfer to P&L and how should you allocate that? So that is what is the question, right? Now, if we come back here, in this particular issue or in this particular paragraph, it spoke about they have acquired something and there is goodwill. So here is where you will have aspects related to impairment as well. Okay. So if you read this issue, on 1st of April, Sahana Fashion acquired 100%. So there is no minority or non-controlling interest of Spun Limited for 5 lakhs, which was into cotton spinning business. Fair value of identifiable asset was 4.5 lakhs and goodwill was 0.5 lakhs. Means if you have to calculate what is the total investment is 4.5 plus 0.5, a total of 5 lakhs. On 31st March, the government changed its policy on textile sector, having adverse impact on business of companies like Spun. So, if there is an adverse impact on the business, then this can be an external indicator of impairment. So, we'll have the discussion as well. Internal discussion on government policies indicate that revenue of Spun Limited is estimated to fall by 20% in coming 3 to 5 years. The adverse effect of the marketplace and regulatory conditions indicate impairment. So this is where they're saying that there is an indication of impairment. Now here, whenever we look at this type of question, these discussions and these indications are not a relevant information. For us, relevant information is yes, there is an impairment. As a result, they have to estimate. So again, do they have to estimate? Yes, they have to estimate. Again, this statement has no relevance when we write the answer. Sahana Fashion Limited uses SLM depreciation. Useful life of asset is estimated to be 15 years with no residual value. Further, no independent cash inflows can be identified to any individual asset. So the entire operation of Spun. Now, what is Spun Limited? Spun Limited is the entity that we have acquired. So the entire operation of Spun Limited is to be treated as a cash generating unit. Due to the regulatory entangle, it is not possible to determine the selling price. Its value in use is estimated by the management to be 3.02 lakhs. So what they have done, they have estimated that, okay, this is the value in use, and that has been estimated at how much? 3.02 lakhs. Now tell me one thing, this 3.02 lakhs, should I compare with 4.5 lakhs or should I compare with 5 lakhs? Which one should we compare with? We should compare this with which number? While calculating impairment, value in use has been given. Okay, what is the carrying amount of the CGU? As per Ind AS 36, what will be the carrying amount of the CGU? 3.02 is value in use. Sorry, 3.2, not 3.02. 3.02, yeah. 3.02 is value in use. Okay, 3.02 is value in use. Means that is the amount that we can recover. That is what is called the value in use. That is the first part. Now, the second part of the question that that is being asked or that we are looking at is what should be the carrying amount. Now, again, if you come back and see here, we acquired on 1st of April of 22. 100% of Spun Limited, which was into cotton spinning business, fair value of net identifiable assets was 4.5 lakhs and goodwill was 0.5 lakh. Now, what is this? This is on the date of acquisition. So let me just open one Excel sheet, which will help you understand this. Date of acquisition is 1st of April of 22. Okay, this is the date of acquisition. Now, whenever we acquire a business, what we do consolidation. Okay, we do a consolidation, or if it is if the entity is merged totally, then we actually incorporate it as per Ind AS 103 and continue to account for it. Now, on the date of acquisition, assets of CGU is 4.5 lakhs, or I'll put it this way. Assets is 4.5 lakhs. Goodwill is 0.5 lakh. This is given in the question. Okay, so there is no confusion here. They have said the fair value of net identifiable asset is 4.5 lakhs and goodwill is 0.5 lakhs. Okay, that is what is given in the question. Now, that was on 1st of April of 22. When are we calculating the recoverable amount? We are calculating on 31st of March of 24. So this asset, whatever we have acquired, that asset we have to depreciate. Now, how will we depreciate? They have told us that they have 15 years of useful life. So what we will do, we will calculate depreciation considering 15 years of useful life. 4.5 divided by 15 multiplied by 2 years, we get 0.6. Sir, why 2 years? April 22 to March 23, 1 year. March 24, 2 years. So depreciation for 2 years is 0.6 lakhs. Goodwill will not calculate any amortization. We'll only test for impairment. So carrying amount is 4.5 minus 0.6, 3.9, and carrying amount of goodwill is 0.5. Is there any question so far for the for the calculation that we have done with the information that is provided? Do you have any questions so far? So the total CGU carrying amount is 3.9 plus 0.5, 4.4. This carrying amount we will compare with the recoverable amount. Now, as far as the recoverable amount is concerned, what is recoverable amount? Can someone tell me what is what is the definition of recoverable amount? What is the definition of recoverable amount? Only value in use? Okay. Is there someone who has not yet done Ind AS 36? Ind AS 36 impairment. I hope all of you have completed that standard. Okay. Expected future cash flow is also not a value in use. So, okay, I think better I'll revise the concept to all of you so that you are not confused. Discounted future cash flow, okay, that is value in use. I am asking what is the recoverable amount? What is the meaning of recoverable amount? What is the meaning of recoverable amount? That is my question. No, current market price is not the recover. Okay, my question is first, have you completed Ind AS 36? Yes or no? If you have completed, yes, you can write yes. If you have completed, if you have not completed, you can write no. No problem. Completed. Okay. Now, when we talk about, okay, Dheeraj has not completed. Okay. Others. So what I'll do is, I will first, because we are not able to give a proper definition of recoverable amount, let us have a look at the standard, what it says. So recoverable amount consists of two parts. Recoverable amount, if you look at the screen, it consists of two parts. One, fair value minus cost to dispose or cost to sell, whatever we say. Second, value in use. Whatever is higher or whichever is higher will be a recoverable amount. Is this clear? I hope it is now your memory is refreshed and you are able to recall it. Recoverable amount is higher of fair value minus cost to dispose and value in use, whichever is greater. So here, in the question doesn't have so here if you see the question, if you see, what does it say? Due to regulatory angle, it is not possible to determine the selling price of the CGU. Means you're not able to determine the selling price. Because of that, you're not able to determine value, fair value. So next thing, what you will determine? If you cannot determine the first part, you will determine value in use. Now, for value in use also, they have given an estimate by the management, which is 3.02 lakhs. Okay, so because fair value is not available, we will take value in use, which is 3.02 lakhs. Okay, so recoverable amount or value in use is 3.02 lakhs. So impairment loss, see, carrying amount means the amount at which I am showing in the books. In the books, I am saying I have an asset worth 4.4 lakhs, but the value that I will get from the asset is only 3.02 lakhs. So 4.4 minus 3.02, impairment loss comes to 1.38 lakhs. Impairment loss comes to 1.38 lakhs. Now tell me one thing. This impairment loss should be allocated to which asset first? I think this all of you should be knowing. Which asset should we allocate the impairment loss first? Goodwill, not net assets. First, the impairment loss should be allocated to goodwill. So whatever we have incurred as loss, 1.38, first you will write off goodwill. So entire goodwill 0.5 is gone. Then balance to other assets 1.38 minus 0.05.88, 0.5.88, balance to other assets in the proportion of their carrying amount. So this principle you have to keep in mind. That is, order of allocating impairment loss of assets of CGU. First, reduce the carrying amount of any goodwill. Then to other assets on a pro rata basis on the basis of their carrying amount. Okay, so that is how we will do. So now once we have done that, so what did we get as answer? Goodwill should be written off 0.5 and 0.88 we should write off to other assets. Total impairment loss is 1.38. Now let us see which options give us the answer. Impairment loss should be what? 1.38 that we have calculated. So either B or D. And the same should be allocated to goodwill and other assets proportionately? No. The same should be allocated to goodwill first? Yes. And the balance to other assets. So option D is the correct answer. Okay. So that is as far as the first question is concerned. Second question related to financial reporting, what we have is more like a theoretical question. Okay. More like a theoretical question, but just don't write theoretical question. Okay, we will give the internal sources, external sources, whatever is asked in the question, but then we should also apply that in the given scenario. Okay, now what is the question? Sahana is intrigued. Intrigued means confused or worried or tense, something like that, by the concept of impairment and wants to understand if an asset once impaired, can it be reversed? So what is the first question? If there is an impairment, can we reverse the impairment? That is the first question. Okay. And what is the second question? The second question is source. In this question, explain in brief accounting for reversal of impairment. That is the first question. Option D only, no? We took option D only. What did we calculate? 1.38. 1.38. So 1.38 either B or D. B says impairment loss 1.38 and the same should be allocated to goodwill and other assets proportionately. That is incorrect. First you should allocate to goodwill and then balance to other asset. This is what is correct. I think in a flow either you would have missed or I would have missed, but option D is the correct answer. Okay, that is what we are discussing. Now here coming to the next question. What does it say? Explain in brief the accounting for reversal of impairment. So first, how do we reverse the impairment? That is the first question. Second, source of information which indicates reversal of impairment loss. Now here basically there is nothing we can directly relate to the case. It is more like a theory question. Okay, so let us quickly have a look at the concept of reversal. And one thing, one question for all of you. Can we reverse impairment on goodwill? Can we reverse impairment on goodwill? We cannot. Goodwill once impaired, we cannot touch. So one thing you keep in your mind, goodwill can be accounted or recognized in the books only when you pay some amount to acquire a business or something like that. After that, you cannot change. Even if you can bring it down, if you have to bring it up, you have to pay something. Only then you can bring it up. Otherwise, you cannot bring it up. Okay. Now, so let us quickly have a recap of impairment reversals. At every balance sheet date, the entity should assess whether there is any indication that the impairment loss recognized in the previous years may be decreased or no longer exist. Okay, so that is one. Impairment loss recognized for goodwill shall not be reversed in a subsequent period. So this is one thing you have to compulsorily write in the examination. Then here in the second part of the question, if you see, they say source of information which indicates a reversal of impairment loss. So basically what it is saying, what are the sources of information? So these are the sources of information. First, external indicators. Significant increase in market value. That is, if the market value has increased, then it represents reversal of impairment losses. Significant changes in technological, economic, legal, and market environment, which has a positive effect on the entity. Now, in the given example, the regulatory environment is adverse. In our case that we are discussing, regulatory environment is adverse. So that is a indicator of impairment. But if the regulatory environment improves, then it becomes a positive thing. So that will result in reversal. It is an indicator that there is a reversal of impairment, right? Then then decrease in market interest rate. Now, this is one thing what you have to understand is the interest rates in the market, they have a, just give me a moment. Switch my camera. Significant, third one, a decrease in market interest rate. Now, one thing that you have to keep in mind is the relationship between present value and interest is inverse. Meaning to say, if interest increases, present value decreases. If interest decreases, present value increases. So here what we are saying, we are saying that market interest rates have decreased. So if the discount rate decreases, present value increases. If present value increases, value also increases. Okay, that is the first part, external indicators. Then internal indicators of impairment reversals. Significant change in the way the asset is used or expected to be used. This means we have got new ways to use the asset. Evidence from internal reporting that indicates the performance of the asset is better. That is another example. Withdrawal of commitment for restructuring discontinuing operations, which gives a positive effect. So this basically means if you are discontinuing an operation, it can indicate impairment. Now we are saying we are no longer discontinuing the operation. So it can be a reversal of impairment. Okay. Now, second part you have answered, source of information. Third, explain in brief the accounting for reversal of impairment. Now, as far as reversal of impairment is concerned, when you have to explain the accounting treatment, first what you have to write is goodwill cannot be reversed, or if at all there is a indicator of reversal of impairment, goodwill cannot be reversed. Okay, that is first thing. Then how will you recognize impairment reversal? If no revaluation is there in the previous period, that is, if no evaluation is existing in the previous period, then you will credit you will increase the asset amount and you will credit impairment loss, or you will credit the P&L. Okay, so that is the first one. If there is a no revaluation done in the previous period, and we will also mention that the increased carrying amount of the asset shall not exceed the carrying amount that would have been determined had no impairment loss been recognized in the asset in the prior years. Now, what is the meaning of this? This I'll just explain you using a quick example. Let us say cost is 100,000, useful life is 5, depreciation per year is 100,000 divided by 5, 2,000. Value at end of year 1 is 100,000 minus 20,000, 80,000. Okay. On this date, say for example, recoverable amount is 70,000. So what is the impairment loss? Impairment loss is 80,000 minus 70,000, 10,000. Now, this recoverable amount 70,000 will be the new carrying amount. So opening balance in year 2 is 70,000. Depreciation. Now we have only 4 years left. So 70,000 divided by 4, 17,500. Carrying amount is, let us say, 52,500. Now, if recoverable amount on this date is 65,000, what we need to check is if there was no impairment in the previous year. If there was no impairment in the previous year, what will be the carrying amount? So if there is no impairment, this will be 80,000, this will be 20,000, carrying amount will be 60,000. So the statement that we just read, what it means is you cannot show the asset after reversal of impairment at 65,000. You have to show it only to the maximum of 60,000. It cannot be shown above that amount which would have been calculated if impairment was not recognized. So what this means is the increased carrying amount of the asset shall not exceed the carrying amount that would have been determined had no impairment loss been recognized in the asset for the prior years. Okay. And maximum impairment loss reversal is impairment loss previously recognized. Then if revaluation is done in the prior period, then means if it is a revaluation model, the first one is cost model, second one is revaluation model. A reversal of an impairment asset is recognized in OCI income and it increases the revaluation surplus for the asset. So here two things you have to keep in mind. First, any revaluation asset means asset which is done or which is accounted using revaluation model. Any reversal of impairment is treated as if it is a revaluation surplus. So you will treat as if you have done a revaluation increase. So whatever you learn in India 16 for revaluation, same treatment is applicable here. Reversal of an impairment loss is recognized in OCI and increases the revaluation surplus. Means if there is a reversal of impairment, you will increase the revaluation surplus. And however, to the extent that an impairment loss on the same revalued asset was previously recognized in P&L, reversal will also be recognized in P&L. So this is enough for this particular answer. That is, if it is a revaluation model, any increase or any reversal of impairment will be recognized in revaluation surplus or under OCI. But if you had earlier done a downward revaluation and you have debited P&L at that point of time, now you will credit the P&L. So the summary is you will increase the amount of asset, you will credit revaluation surplus, you will credit impairment if earlier you had recognized the revaluation, downward revaluation in the P&L. If at all you have, you are not able to comprehend this revaluation surplus, quickly revise Ind 16 revaluation model. That will help you understand this part, right? So that much is enough as far as the accounting treatment is concerned. Okay. So what you have to write? One, goodwill will not be, you will not increase the amount of goodwill. Second thing that what you will write is the carrying amount shall not be more than the carrying amount that would have been if no impairment was charged. Then if an asset is following the cost model, you will reverse the impairment to P&L. If the asset is following revaluation model, you will treat as if it is a reversal of revaluation. You will treat it as if it is a revaluation increase. Okay. So that is, then the remaining aspects are related to your, what do you call law and taxation that will be handled or that would have already been handled by now. Okay. So impairment, as far as this is concerned, we got a direct theory question. Now here, if the question asks you, what is the indicator of impairment? Explain. For example, explain in brief source of information which indicates impairment loss. Now in that case, what you have to do is, you have to write the impairment indicators. Indicators of impairment, external and internal. And you have to relate it with the case. How do we relate it with the case? We come back to the question in here if you see. Because of changes in government policies. And do we have it? Significant changes in technology, market, economic or legal environment. So legal is the environment, government policy has changed, and because of that, it has an adverse effect, and hence it becomes an indicator of impairment. So Dheeraj, this entire set of notes is not relevant for you. Okay. So what I'm doing is I'm actually extracting important parts of each of the index, concising, making it concise, and you can expect that in the coming week by Monday, Tuesday. The entire set, if you want, it is already there on our app in free resources. Okay, but if you cannot carry, 400-500 pages of FR, right? It has to be at least 150 pages, which you can, 150 to 180 pages, which captures the crux of what you need to carry for the examination. So that is the whole purpose. Okay. Right. So that concludes this particular case study from as far as FR is concerned.
Hello, my dear students. A very good evening. I'm sure I'm visible and audible to all of you. Kindly please confirm. Kindly please confirm that I'm visible and audible to all of you. Yes, thank you so much for your wonderful participation. So friends, come on, without any delay, in this particular session, we'll talk about some interesting case studies, which actually makes a lot of meaningful sense. So without any delay, let's start the discussion, my dear friends. Come on, let me share the screen. Just a second. Are you able to see the screen, my dear friends? Is the case study visible for you? Yes, thank you so much. So in the previous session, we have discussed about case study number 6, 7, and 8. Now let me talk about some interesting case study called case study number 10. In fact, the last session itself, I had a plan to discuss this, but the time was running short. That's why I couldn't complete this. But this particular session, we'll talk about this case study 10 first. See the case study, my dear friends. It's an interesting case study, actually. Sahana is an MBA graduate from IIM Bangalore. Sahana and her father incorporated a company, SAH Fashions Limited, to set up a boutique and a chain of ready-made garment stores to support their family business of cotton and yarn mills. So the family business is cotton and yarn mills. So they want to set up a boutique and a chain of ready-made garment stores. She was able to manage the accounting and taxation part of her business by herself in the initial stages. So initial stage, she managed accounting and taxation on her own. Now see, considering the business expansion, she was evaluating to hire a professional consultant who would support in all the business matters, including taxation and accounting. She reached out to her old friend Madan, a practicing chartered accountant, to seek his help on accounting and compliance matters related to the company. Madan set up his own proprietorship firm and has been in practice, specializing in audit and taxation since last 10 years. So Madan is a practicing chartered accountant since last 10 years now. When Sahana contacted Madan for professional help, he was more than glad to support her. So sweet of them. They meet up at a coffee shop to discuss the details of engagement. And during the conversation, Madan tells her that times have changed and so have the ways of presenting accounts of any business. Obviously, your index is different, your presentation is different, your taxation rules have changed, taxation sections have changed, rates have changed. He explains how the preparation of financial statements is now regularized in such a way where all such financial statements shall have a consistency or uniformity across the industry, with few exceptions. Example, specially regulated financial statements. In addition, users of these statements would also have an assurance of complying with basic framework. He also gives her an overview of latest changes in income tax and GST, which could have an impact on her business. So wonderful. After a detailed conversation of accounting and taxation aspects, he asked Sahana to brief him about her business and the issues she is facing. The meeting gets more formal as Sahana calls Murari, the accountant working in her company, to the meeting. Sahana explains the following open issues to Madan. Sahana opines that Murari is not computing the depreciation on plant and machinery appropriately. WDV of the plant and machinery is 30 lakhs. That is basically the opening WDV. New plant and machinery purchased and put to use on 8th June 2023 is 20 lakhs. New plant and machinery acquired and put to use on 15th December 8 lakhs. What is that concept that should come to your mind the moment you see this? In case of depreciation, under income tax law, section 32 clearly specifies that in the first year of purchase, if the new plant and machinery is put to use for less than 180 days, we claim only half of normal depreciation. And if it is put to use for 180 days or more, we'll claim full depreciation. And see below, computer acquired and installed on 2nd of January This also will claim depreciation, but will claim only half depreciation. Next slide, you see. Next slide, what did they give? Qualified for additional depreciation at 20%. So nice. Additional depreciation will take only on new plant and machinery. Basically, for associates who are engaged in manufacturing, to promote that manufacturing activity, income tax department gives additional depreciation under income tax. And this concept is given by section 32(1)(2)(a), additional depreciation. Next point. As per Murari's working, the total maximum depreciation on machinery at 15% comes to 8.7 lakhs. And on computer at 40% comes to 1.2 lakhs. That is Murari's working, but not as per income tax. As per income tax, what is it? We'll see. If they ask, we'll see. Next slide. On April 22, they have acquired 100% of Spun Limited, which was into cotton spinning business. Fair value of identifiable assets. So this is all related to your financial reporting. Nothing to do with taxation. Next. Issue number 3. Geet was appointed as new MD of the company. Companies Act. This is also related to your corporate laws, not related to your taxation. Next. Company at the annual general meeting held on 30th September related to corporate law. See, the whole point is all about the moment you read 1-2 lines, you should be in a position to identify whether the question, whether the case study, whether that particular paragraph is talking about corporate law or auditing or FR or taxation. That clarity should come. Next slide. Besides company-related matters, Sahana asked Madan to advise her in her individual tax matters too. Wonderful. She is planning to buy a residential flat for her own residence, which is priced at 48.5 lakhs. The person selling the flat, Rainbow, is NRI, as per provisions of income tax. Sir, whenever we buy a property from a non-resident, we are supposed to do TDS under one brilliant section called section 195. And there is no limit called 50 lakhs and all. Let me make you recall, there is one section called 194 IA in income tax, where TDS is done at the rate of 1%, and that story will come only when the property what we purchased is 50 lakhs or more. But that story will come only when the seller is a resident. But in this particular question, seller name is Rainbow and seller is a non-resident. So TDS provision is not governed by section 194 IA, but TDS provision is governed by section 195. Next slide. After the title gets transferred, the flat will be renovated with a total cost of 60 lakhs approximately. So 48.50 lakhs is for purchase, 60 lakhs is for renovation. So costly interiors. Mother was quite astonished when he got to know that renovation cost is more than purchase price of the flat. Yeah. Sahana informed Madan that she is purchasing the flat due to her father's emotional attachment with the locality and evaluating to finalize a contractor for renovation work to make the interiors as per the liking. Apparently, Murari informed her that there would not be any compliance under income tax towards the flat purchased and proposed renovation. That is not acceptable at all. Because when you do a flat purchase, you are required to do something called TDS. Getting my point, everybody? Sir, there is no doubt about it that TDS provisions will apply. Friends, are we getting clarity on this point, everybody? Yes, can I proceed? Kindly please reply. I'm waiting for your answer. Good. Very good. Come on. That should be the participation. Next point. Multiple choice question. Done. Is the maximum depreciation available under income tax calculated by Murari is correct? If not, what is the maximum available depreciation as per the details given in issue 1? Let's go back to the details in issue 1. Where they gave opening WDV, where they gave new plant and machinery, where again gave new plant and machinery, and they also gave computer. Come on, guys. Let me do the working. Come on. First of all, generally the point to be noted is that as per section 32, in the year of purchase, if the asset is put to use for less than 180 days, then half of normal depreciation is allowed. Further, additional depreciation is allowed at the rate of 20%. However, if asset is put to use for less than 180 days, then additional depreciation, then what is that word, sir? Additional depreciation is allowed at a rate of 10% and balance 10% in next year. That is a beautiful point. Did we get the clarity on this point, my dear friends? Friends, come on, please reply. Additional depreciation, how much will come? At the rate of 20%, but if we put use for less than 180 days, we'll get only 10%. And the balance 10% will claim in next year. Come on, my dear friends, what is the open WDV? First of all, there is 2 blocks here, plant and machinery block, computer block. And I'm sure everybody knows that under income tax law, we charge depreciation based on block of asset. What is open WDV, my dear friends? Open WDV is 30 lakhs. Computer is 0. Add asset purchased. New plant and machinery on 8th June. What is the value, my dear friends? 20 lakhs. Next. New plant and machinery on 15th December. And the moment it is 15th December, what will happen is we'll claim only half of normal depreciation, which is 8 lakhs. Computer on 2nd January. This is also half of normal depreciation. How much is the figure, my dear friends? 3 lakhs. And from that, we'll reduce something called asset sold. And in the question, nothing is given. The balance what we get is called closing WDV, which will be this figure plus this minus this. This will only be 3 lakhs. I strongly believe that we got clarity on this point. Come on, my dear friends. How do I calculate normal depreciation? How do I calculate normal depreciation, my dear friends? Normal depreciation will be 8 lakhs into 15% into 1/2. Wait a second. 8 lakhs into 15% into 1/2 plus, again I put in the brackets, 50 lakh into 15%. 8 lakh into 15% into 1/2. Then what, my dear friends? Then what is the answer? Come on. Then what is the answer? 50 lakh into straight away 15%. Then this figure will be 3 lakhs into 15%. Wait a second. This computer, right? With this computer depreciation rate is actually 40%. But since it is put to use for less than 180 days, I'll claim it as 20%. And the additional depreciation, my dear friends, additional depreciation, what I'll get is 20 lakh into 20% plus 8 lakh into 10%. This will be 0. And my total depreciation will be this plus this. And it will be this, which will be 12,90,000 plus 60,000. And nothing but my total depreciation is, my dear friends, 13,50,000. 13,50,000. That becomes my total depreciation. And my answer is nothing but, where are my options? Come on, friends, where are my options? 13.5 lakhs, which is nothing but answer is option C, my dear friends. A very, very, very interesting question. And I strongly believe that you got very good clarity on this point. Kindly please reply, my dear friends. Did we totally understand this depreciation working? Please reply, come on. Good. Yes, yes, yes. Thank you so very much. Come on. Next point. Second question is related to financial reporting. Third question, contract of service, identify correct statement. These are also not related to your taxation. Fourth question related to directors. Fifth question is Sahana. What is that word, my dear friends? Come on, guys. 1 second. Is Sahana not required to comply? Is Sahana not required to comply with provisions under Income Tax Act 1961, considering her individual tax returns are not subject to audit? If she is not subject to what, my dear friends? Tax audit. I repeat once again, my dear friends, if it is not subject to what? Tax audit under Income Tax Act, they're asking what is that TDS is supposed to be done. First of all, my dear friends, on purchase of property, she is supposed to do TDS under one section called Section 195. Under Section 195. And even for contract payments, my dear friends, TDS provisions will apply. There is no doubt about it. In fact, even though she is not subject to audit under Income Tax Act, my dear friends, let me tell you, there is a brilliant section called 194M, which says that if payment to contractor is more than 50 lakh, still TDS will apply. So first option, 194IA, forget that. Second option, TDS under 195 for purchase of property, and TDS on contract work and contract as a contract value is 60 lakhs. Definitely answer is correct. TDS is not got 195, wrong option. Not deducted under 194IA, it's less than 50 lakhs. And no TDS on contract work. This is also nonsense option. Answer is option B, my dear friends. Very, very interesting point. Are we getting clarity on this point, everybody? MCQ 5. MCQ number 5. That is very clear that in case of purchase of property from non-resident, TDS will apply under Section 195. And there is no limit of 50 lakhs. Further, in case of payment to contractor by individual or HUF whose turnover during preceding financial year does not exceed 1 crore in case of business or 50 lakh in case of profession, then TDS under Section 194M will apply provided payment is more than 50 lakhs. That's it. Are we getting clarity, everybody? Student asking, so what is the TDS rate for purchase from non-resident? When we buy from non-resident, my dear friends, if it is long term, we'll do 20% TDS. We'll add surcharge also if the property what you are buying is more than 50 lakh, more than 1 crore and all. And of course, we'll also add HEC, health and education cess. And since in this case it is less than 50 lakh, we'll do TDS at the rate of 20.8%. 20.8%. Are we getting clarity? Good. Thank you so very much. Come on, guys. Let me proceed. Yeah. Done. So, descriptive question. First bit talks about accounting for impairment. Impairment is not a part of your taxation. That's it. And eighth question is executive non-executive directors, that is related to your corporate law. But I think we can talk about question number 7. Sahana wants to know if their company missed some invoices while claiming GST ITC. Till what time ITC can be claimed? She believes the same may be taken till filing GST 3B return for the month of March of the concerned financial year. Is her view appropriate? Definitely answer is no, my dear friends. Because let me tell you very clearly, the maximum time limit to claim input tax credit, that concept is given by section 16(4). Section 16(4), which clearly says that as per section 16(4), the maximum time limit to avail input tax credit, to avail what, my dear friends? Input tax credit is 30th November following the end of financial year, or date of filing. It is not due date of filing, it is date of filing annual return, whichever is earlier. In fact, once upon a time, the concept was due date of return for September month following the end of financial year. This point got amended last year and they gave time till 30th November. Good, majority gave answer perfectly. The maximum time limit is 30th November following the end of financial year, or date of filing annual return, whichever is earlier. So before I close this case study, let me ask the students, my dear friends, what is the due date for annual return, my dear friends? And which form do you file annual return generally? Come on. To give you a perspective, my dear friends, the due date for annual return is what? Come on. 31st of December following the end of financial year. And what is the form in which the annual return is filed? It is filed in the form known as GSTR 9. And let me also tell you, annual return is optional for those whose turnover does not exceed 2 crores, my dear friends. And some students talk about something called GSTR 9. GSTR 9C. GSTR 9C is a self-certified reconciliation statement, and 9C is filed only by those whose aggregate turnover is more than 5 crores. So this is an interesting case study which covers both direct tax as well as indirect tax. Are we clear with this point, everybody? I'm sure this makes a lot of meaningful sense. Good. Thank you very much. So that's the end of story of this case study number 10, my dear friends.